we definitely see more lingering inflation.
That reaction function is definitely more tilted towards the weakness in the labor market as opposed to potential upside, risks from inflation.
I don't think the Fed really set us up for 50.
Given the inflation backdrop, it'll be pretty much premature to start cutting aggressively at this point.
We still have a lot of additional inflation from tariffs in front of us.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, it's CPI day. Investors are positioning for another soft inflation print as 3 days of gains sends equities to fresh record highs. President Trump is still pushing for the Federal Reserve to go big. The data drops at 8:30 Eastern Time.
And we have lowered the bar so much that people are looking at CPI that probably is going to come in yet again above that 2%, above 3%, possibly increasing from last month on an annualized basis. And yet people are talking about, well, it's cooling down, and so everything is great to cut rates. It highlights how everyone is focusing on the labor market and focusing on looking through inflation, which raises the question, what would it take for inflation to get the market's attention?
Muted tariff pass-through so far. Muted so far. Does that open the door for this Fed to be a little bit more aggressive next week?
It sounds like it, especially when the Federal Reserve Chairman Jay Powell said at Jackson Hole that it's going to be one-time price adjustments, not at the same time, which means basically we can look through any sort of hot CPI print. Now, on the heels of the PPI, President of the United States is calling for 50 without actually saying 50. He said yesterday, no inflation too late, a.k.a. Jay Powell, must lower the rate big right now. What does big mean? He's not calling for 25. He's calling for a jumbo rate cut.
50 and then again and again and again and maybe well into 2026 with comments like this from the C-suite on Wall Street. James Fraser speaking to Jemana Basechi over in Dubai, saying our client base now is really starting to act with confidence. Put that together with the language coming from David Solomon over at Goldman Sachs, who doesn't look at this market and see any restrictiveness from this Federal Reserve whatsoever.
And when you take a look at profitability of S&P 500 companies and the fact that they've increased their EPS projections in double-digit levels, the fact that Jim Zelter yesterday from Apollo was on and said that he still sees that inflationary pressure coming back. You put this together, you've asked the question, and I think it's an important one, is the Fed cutting to spur some sort of reacceleration or cutting into a reacceleration that could allow inflation to be stickier? Watch for the long end of the yield curve right now. It's pretty quiet, so not exactly expressing those concerns.
Jane Fraser said that their client base is now starting to act with confidence. She talked about the cloud that is now basically evaporating in terms of policy uncertainty. Said corporates are now on the front foot because they have policy clarity when it comes to tax, when it comes to tariffs, and also this welcoming of what is going on in Washington in terms of deregulation.
The data, 8:30 Eastern Time. Futures this morning, firmer by 0.1% on the S&P 500. Coming up this hour, we'll catch up with Steve Chiavarone of Federated with stocks at all-time highs, Waldemar Szlezak of KKR on Oracle's monster rally, and Joe Davis of Vanguard counting us down to CPI data. We begin this hour with stocks sitting at record highs ahead of today's inflation print. Steve Chiavarone of Federated writing the following. While everyone is looking for a mini recession to come, we think it already happened. Weak data in the rearview mirror is primarily how the Fed views the world and will lead them to a cut next week. Steve, welcome to the program, sir, and good morning to you. Do you believe then the worst of the data is behind us?
I think it is. I mean, I think the data that we've been getting is showing it's new information about old news. We know the earlier part of this year was weaker, the immediate aftermath of Liberation Day, John. We saw it. We had a negative GDP print. We had what I think once they take the revisions and break them down into monthly numbers will show a string of negative jobs months. We know that earnings estimates fell. We know that confidence fell. And we also know that that's reversing itself. We know that confidence has since rebounded. So have earnings estimates. We see that the market's acting with early cycle. The Fed's looking in the rearview mirror. It's going to lead them to cut. We think they're going to do the right thing for the wrong reason. They need to cut because there are parts of the economy that have been in recession. Housing, autos, shipping, low and middle American consumers have been in that position. And so it is both true at the same time, in our view, that the economy is set to reaccelerate. And it is also true that it's appropriate to cut. And we've said all along that we think that 6 cuts between now and the end of next year is not only what is appropriate, but what is likely.
So, Steve, let's talk about market outcomes. The Federal Reserve is going to cut interest rates. As you're looking for a pickup in the U.S. economy, where do you want to place your bets in the market at the moment?
think you've gotten a preview over the last month or so, right? I mean, you're starting to see early cyclicals start to perform, right? Whether it's some of the home builders, whether it's the banks, whether it's even some of the shipping companies, whether it's the consumer play. Again, remember, if you're a consumer that has debt, you have been under pressure for high rates for 2 or 3 years here. You get a little bit of relief, and that's going to help. And then also look at small caps. You saw small caps outperform by 6.5% last month. That really is the nexus between rate sensitivity and cyclicality. And we think the economy is going to turn up a bit, and we think rates are going to come down.
You said we've gotten a preview over the past couple of weeks, and I think that we have, and it's come in the form of gold, reaching all-time highs. And it raises the question, has the U.S. tacitly accepted a 3% inflation target by cutting rates into what seems like a persistently elevated inflation backdrop with a lot of concerns about it remaining in place for the next couple of months?
No, I don't think so, Lisa. Yes, headline inflation numbers are somewhere between 2.5% and 3% right now. But again, and this is the difference between looking through the windshield and, the cracked rear view mirror that I think the Fed has gotten itself caught into. And if you look in the windshield, here's what you see. You see an economy that has added at best 35,000 jobs on average over the next 3 months. That is not a recipe for wage inflation. Services are 60% of CPI. You have home prices that are negative 4 months in a row nationally. That's not common. And again, that's a third of CPI. So, all right, I get it. The inflation rate over the last 12 months is between 2.5% and 3%. But our job as professional investors or market forecasters or economists or policymakers is to look at where that's going. And if home prices are coming down and wage inflation or the ingredients for wage inflation are not there, then at some point you got to make the call that inflation is heading lower. If you wait for it to get to 2 before you start to remove restrictive policy, then you're going to find yourself very much behind the curve, and you're going to have a much deeper slowdown than you would otherwise have to have. We're not talking about getting the easy policy. We're talking about going from 200 basis points of restrictive policy down to something closer to neutral. I don't think that's accepting a 3% inflation target.
The picture that you're painting suggests that we could see bonds and stocks rally at the same time, that we could see even long bonds rally if what the Fed is trying to do is not necessarily be behind the curve as much as they may already be. Is that what you're saying, that you could actually see another kind of Goldilocks scenario in the next 12 months?
I think that environment is more bullish for stocks than it is for bonds, at least on the long end. I think, in our view, what is most likely to happen is, kind of 2-year yields are likely to come down to where the federal funds rate is headed. We think that's 3%. Now, if you want to argue and say it's 3.25 or 3.5, that's fine, but somewhere near neutral. So the 2-year yield, we think, has some real material downside. The 10-year yield at, essentially 4%, we think that's about where it belongs. In our view, a kind of 2.5% inflation rate, a 3% federal funds rate with about, let's call it 100 basis points of term premium is about right. So we think the long end of the curve has actually done most of its rallying. What we think you'll see instead is short bonds will rally. We think equities can continue to rally. But that long end, I think, probably has a little less opportunity.
Steve, we heard from Jane Fraser today, speaking to one of our colleagues, and talking about the fact that clients now have confidence because there's more clarity in Washington. When it comes to things like tariffs, that's actually being debated in the courts. What if IEEPA gets struck down? Will that upend how you feel about potentially where the market is right now?
Yeah, so one, our view is that it probably won't get struck down, particularly because the administration has made such a case about the national security implications. But, so that's our base case view. If they were struck down, I think the most apparent negative impact would be on the long end of the bond curve. Whether or not you like tariffs, that's up to you. But what's clear is that the tariff revenue is the offset to the one big beautiful bill in terms of revenue. If all of a sudden, $4 trillion of revenue over 10 years goes away, that's going to push long bond rates up. So again, it doesn't matter how we got here. From a bond market perspective, tariffs going away would be a negative, particularly on the long end of the curve. But remember, there are other remedies. And so I expect that what you would see if IEEPA was struck down, as an example, is that the administration would pivot to other authorities to at least kind of implement a 10 or 15% across the board tariff for some period of time. They would then move into sectoral tariffs. So I think if what you're waiting for is tariffs are going away, I don't think that's going to happen. I think this is the core tenet for the administration. They view it on national security grounds, and it might be messier, but they're going to be in place. And I think the level, which is really what the market is most interested in, is what's the overall level of this, has been established at 15%. And I think it would be recreated at something close to 15%. So is there uncertainty around tariffs? Sure. But is there the kind of uncertainty that existed in April that caused the economy to freeze? And I think that's behind us.
And looking forward, you note that next year there's the World Cup, there's a 250th anniversary. What kind of economic impact do you see from just those two events in 2026?
I think there's a lot of economic impact coming from a number of things, right? So first off, monetary easing likely starts next week. And we're not talking about 25 or 50. I really don't care about 20 or 50. What we're talking about is it 5 cuts or 6 cuts over the next 18 months. That's the bigger question. And it's somewhere in that range unless we get really surprised by the data. That's stimulative, or at least it's less restrictive. Then you have the stimulus of the one big beautiful bill that hits in January. We have not changed withholding tables so far, which means you're probably looking at bigger than expected tax return seasons. And back to school has been good so far in terms of spending. It's up 3.8%. So the consumer is holding in, but there's more stimulus to come in terms of tax returns next year. And then, you have these major economic events, and it does lead to tourism, and it does lead to infrastructure. And so, can you quantify it? At this point, it's probably premature. But when you start to take a look at the totality of monetary policy that's less restrictive, tax relief on both corporates and individuals, and then some of these other economic catalysts that can start to kick in, you get a picture of a 2016 that looks pretty robust, 2026 that looks pretty robust for the United States.
Hey, Steve, appreciate the update. Steve Chiavarone there of Federated Hermes. Constructive on this equity market to address your point head on, cutting interest rates into a pickup in economic growth.
But one that's warranted. And that's what he sort of highlighted, and it's something we've been struggling with. This is a multi-cylinder economy that's quite complicated, and which aspect the Fed can potentially affect is the one that they need to. That, according to Steve Chiavarone.
Stocks are positive this morning by close to 0.2% on the S&P 500. The data about 2 hours and 18 minutes away. With an update on stories elsewhere with your Bloomberg brief. Here's the latest with Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you and good morning. A search is underway for the killer of conservative activist Charlie Kirk. Kirk, the founder of Turning Point USA, was shot as he was speaking to an outdoor crowd at Utah Valley University. The 31-year-old was a close ally of President Trump, who posted about the incident on social media and ordered American flags to be lowered to half staff until Sunday. The Trump administration is appealing the ruling blocking the president from firing Fed Governor Lisa Cook. The government is asking an appeals court to overturn the ruling, which said that the president did not have cause to fire Cook under the Federal Reserve Act. Any ruling against Trump by the appeals court would likely be challenged quickly at the Supreme Court. Hundreds of South Korean workers detained in a Georgia raid will fly home this afternoon after the two countries' top diplomats met in Washington and agreed to resolve a dispute. President Donald Trump agreed to South Korean demands that the workers would not be handcuffed. According to Yonhap News, the U.S. will also consider a new visa category to prevent future problems. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate it. More from Vonnie in about 30 minutes' time. Up next on the programme, a manhunt underway.
I'm filled with grief and anger at the heinous assassination of Charlie Kirk. My administration will find each and every one of those who contributed to this atrocity and to other political violence.
Up next, we'll get you the latest with Bloomberg's Tyler Kendall from New York City this morning. Good morning. Busy morning coming up for financial markets. It starts with this at 8:15 Eastern Time, an ECB rate decision. Then later at 8:30 Eastern Time, 2 points of data for you. Jobless claims and US CPI, the main event later this morning. Going into that, your scores look like this. Equities at all-time highs on the S&P 500. 3-day winning streak. Equities firmer by 0.2% in the bond market. Yields just about unchanged on a 2-year this morning at 3.54. Let's take it down to Washington. Under surveillance this morning, a manhunt underway.
I am filled with grief and anger at the heinous assassination of Charlie Kirk. My administration will find each and every one of those who contributed to this atrocity and to other political violence. It's a long past time for all Americans and the media to confront the fact that violence and murder are the tragic consequence of demonizing those with whom you disagreed.
So here's the latest this morning. Authorities expanding their search for the killer of conservative activist Charlie Kirk. With the latest from the nation's capital is Bloomberg's Tyler Kendall. Hey, Tyler.
Hey, John, good morning. The suspect is still at large, and we know that the FBI is working closely with state and local law enforcement on the investigation. Officials say that around 12:20 p.m. Mountain Time yesterday, a single shot was fired from a building about 200 yards away from where Kirk was addressing this crowd at Utah Valley University. And officials say that the shot appears to have come from a rooftop. Closed-circuit surveillance footage shows a person dressed in dark clothing on that rooftop, and that person is believed to be the suspect. Other than that, no other details have really been released, including what type of weapon may have been used or whether or not it was recovered. Utah officials do say that they took 2 people into custody, but after questioning, they were released. About 3,000 people were in attendance at this event, alongside 6 local police officers and Kirk's own security detail. Utah's Governor Spencer Cox, in a statement, said that this was a targeted attack and called it a political assassination. Of course, Kirk, a very prominent conservative activist and a very close ally of President Trump, who you heard just there. He was one of the first to confirm that Kirk had been killed. John, the president has ordered flags to half staff across the country until at least this weekend, September 14th.
Tyler Kendall in Washington, D.C. Tyler, thank you. Lisa, I think we were all gripped by these developments yesterday, just utterly heartbreaking.
It's devastating, especially for a democracy where people harken back to the words attributed to Voltaire. You know, regardless of what you think about a person's beliefs, I defend your right. Defend to my death your right to say it. And why have we gotten so far away from that type of rhetoric and debate in this country? The political violence deeply upsetting to us this morning.
And it's been pervasive in this country. This is the second summer of this. And what we should be seeing is what we are seeing is both sides coming out and condemning this. And it needs to be condemned to the sharpest degree, and there needs to be really a seismic shift, I think, in this country for political discourse.
There is a manhunt underway. Any developments this morning, of course, this morning, we'll share with you on this story. Let's get the latest elsewhere in Washington, D.C. with Tobin Marcus of Wolfe Research. Tobin, welcome to the programme, sir. I want to talk about trade, of all things, if we can move on from such a delicate subject. Transshipping has been a massive focus for this administration. Now there are some signs that Mexico is falling into line. Tobin, what do you make of the latest?
Yeah, I mean, there's been talk about Mexico imposing tariffs on China as a way of securing more favorable tariff treatment from the U.S. going back to before Liberation Day. There was talk about the Fortress North America strategy and Mexico's possible cooperation with our efforts to pressure China on tariffs as a way of getting themselves better treatment. Thus far, that hasn't materialized, but it certainly makes sense that that's something that they're looking at. You know, I think there are reasons for them to be interested in that domestically, and we've seen the same thing on the European side as well. They have their own concerns about trade with China, even separate from their efforts to appease the U.S. So, you know, I think the developments there are encouraging about the long-term future of what USMCA renegotiation looks like, but we probably have a ways to go.
Well, where's Canada in all of this? Because we see Mexico taking action. We know the Treasury Secretary said he would welcome if Canada followed suit.
Yeah, there's been a little bit less concern. Like it's been a less intense focus on the Canadian side, just because that's been less the story. Sort of Mexico as a nearshoring destination, as a Chinese FDI destination, has been one of the sort of major narratives in response to the imposition of the original tariffs on China during Trump 1.0. So I think that has been an area of greater focus. But to your point, the administration has indicated we'd like to see similar action from the Canadians. That's been a little bit more fraught in general with their kind of retaliation against U.S. metals tariffs in the first instance this spring. But I think that if it's on the table for Mexico, it's probably going to end up being on the table for Canada as well.
Well, if Mexico is appeasing the White House with this move, what will they get back because of it?
So there's definitely still hope that they will get some relief from the metals tariffs. There's been talk for months about the possibility of getting some kind of quota system in place for steel as opposed to the current steel tariffs. We are net exporters of steel to Mexico, so I think there's reason to be hopeful there, although of course it has not come through yet. And then I think they're looking just to have USMCA preserved going forward as a concept. I think we've seen some commitment from the White House to the notion that USMCA should be seen as a regional competitive strategy, that this is something that we're invested in. The sort of modifications of the auto tariffs over time, for example, show some appreciation of the importance of those supply chains across North America, even as the U.S. tariff posture keeps shifting. So, I think they do still need to appease the U.S. for the sake of getting the USMCA renegotiation is next year in a good place, even if they're not getting massive immediate relief in the near term.
Tobin, do you get the sense that there's been a sort of rethink of tariffs on the global stage? I'm looking, for example, at Mexico's plans to raise tariffs by 50% on Chinese cars, steels, and textiles in order to get some sort of better treatment from the U.S. And then it shows, okay, this is also going to raise $3.8 billion for the Mexican government. How much of the revenue side of things playing more into the discussion internationally when they talk about potential tariffs in response to the U.S., maybe to placate the U.S., maybe to counter the U.S.?
I think for most other countries, the tariffs that they're contemplating aren't going to reach the level that they make the revenue sort of a linchpin of their fiscal situations. But obviously, we are seeing fiscal pressures across both developed and developing economies globally. So any little bit of revenue certainly will be seen as helpful for a lot of countries. But I think in the first instance, they are, looking at, on the one hand, mollifying the U.S., and on the other hand, kind of playing whack-a-mole with global trade flows. If you're pushing cheap Chinese exports out of the U.S., that creates sort of even more overcapacity problems on global markets, which has been driving a lot of the conversation on the European side.
Tobin, just quickly, do you think IEEPA is going to withstand the Supreme Court, or is it going to be struck down?
My base case is that the Supreme Court will reverse the two lower court rulings and uphold the tariffs under IEEPA. I think it's a close call for the Supreme Court. I'm at about a 40% chance that they strike it down, which I do think is significantly lower than the consensus seems to be forming in the 60 or 65% range. And I think that, this court is going to be pretty apprehensive about second guessing what constitutes an emergency. We've heard some talk that maybe they'll distinguish between the IEEPA reciprocal tariffs and the IEEPA fentanyl trafficking tariffs. That would put them in the business of saying what is and is not an emergency, which I think they really don't want to do. But I think they're going to be nervous about upending the entire tariff regime that's been built up under IEEPA and sort of throwing themselves into the middle of the political process that way. But I think it's a close enough call. Investors need to be planning for both possibilities. And if they do get struck down, I don't think it's a huge disaster for bond markets. It's a one-time cost to refund about $100 billion worth of tariffs in all likelihood. But going forward, I think they'll recreate something very similar to what we have in place now, and the sort of long-term finances of the U.S. are not going to be changed.
Tobin, appreciate it. Tobin Marcus of Wolfe Research actually wanted some time. We've run out of time to follow up on something he's calling for next year, which is the most underappreciated thing he thinks is going to happen here is the stimulus that the tax bill offers the economy through 26.
This is what a lot of people are talking about, the reacceleration in the U.S. economy, and the reason why people think that the Fed can cut rates even with a reacceleration poised to happen.
Up next on the programme, we'll catch up with Waldemar Szlezak of KKR and what Oracle's surge means for AI. Plus, we'll touch base with Yahira with your morning movers. Klarna pulling back after strong trading debuts yesterday. From New York, this is Bloomberg. Live from New York City, welcome to the program. 3 days of gains on the S&P 500, adding some weight to the rally this morning, up by 0.2 on the S&P. Record high on the Nasdaq 100, up by 0.25 so far this morning. In the bond market, the yield curve looks like this. 2-year, 10-year and 30-year bond yields just a tiny little bit lower this morning. At the front end of the curve, 354.36 on 10s, just north of 4%, 2 hours away from CPI data in America. That's the cross-asset price action. Let's get you some movers, some morning movers. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Oracle shares are still climbing today, up over 1% after they had their best day yesterday since 1992 with that 36% surge in that stock over a very bullish outlook, one that involves a deal with OpenAI, according to the Wall Street Journal, that could be worth up to $300 billion over 5 years. And that major rally yesterday also delivered the biggest one-day wealth jump ever, briefly making co-founder Larry Ellison the richest man in the world. And we stick with tech and move on to Alibaba. ADRs are rising nearly 3% after the company unveiled plans to raise just over $3 billion in a convertible bond sale to fund its AI ambitions. And this is part of a bigger trend we've seen with Chinese tech companies as the competition in AI heats up. And for Baba, it plans to use the funds to scale up data centers and invest heavily in AI because remember, Baba said earlier this year that it would spend more than $50 billion over the next 3 years on AI infrastructure. And we end on Klarna. The buy now, pay later firm had a strong debut yesterday, surging 15% after raising $1.37 billion. But as you can see today, it is giving up some of those gains, down 2.3%. John?
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, our top story, a manhunt underway. Police still searching for the shooter responsible for killing conservative activist Charlie Kirk yesterday. According to the FBI, a person of interest was taken into custody, but later released. Revving up trade talks, Mexico planning to impose tariffs of as much as 50% on cars and other products made by China and several other Asian countries. The move coming ahead of expected talks over North America's free trade agreement. And finally, President Donald Trump keeping up the pressure on Fed Governor Lisa Cook. The DOJ quickly appealing a judge's decision to keep Cook on the FOMC ahead of next week's interest rate decision.
It seems like a two-pronged effort to try to pack the FOMC, if you want to use Supreme Court language, which I know you absolutely despise. But one thing that I find interesting is the likelihood that we could see a person come on the board, Stephen Myron, at the same time that Lisa Cook could be taken off the Board of Governors. And it's sort of this perfect storm that people are looking at to possibly talk about a bigger rate cut than just 25 basis points.
This is obviously, though, going right to the Supreme Court, at least when it comes to Lisa Cook, because if what we see with the judge's order that stays, the president is going to go right to the Supreme Court. And actually, they can even say if the federal court is taking too long that they want the Supreme Court to hear this sooner. We heard yesterday from the White House, this ruling will not be the last say on this matter, and it won't be. I think for investors, it's just whether or not she's going to show up next week. And right now, according to the recent ruling, she will be there at the FOMC. And to your point, Steve Myron, if he gets his vote on Monday, he will also be there.
You know why I'm irked by the comparisons to the Supreme Court? Because when people talk about the FOMC and say the president might have a majority, I think it's absolutely ridiculous. A majority of what? Who? Who's doing the president's bidding on the FOMC? Governor Waller? Governor Bowman? I don't think so.
There's also an equivalency of the Supreme Court as a branch of the government in sort of comparing it to the FOMC, which supposedly has a dual mandate, and that is the guiding light. And there's a real question here. On one hand, you've got the Constitution as the guiding light. On the other hand, you've got inflation. On one hand, price stability versus the employment picture, which is your guiding light, and that should be relatively objective. So it becomes a sort of controversial feeling, which I understand, but yet we hear it all the time, and I just parroted it.
We'll get more data a little bit later this morning, about 2 hours away, 8:30 Eastern Time. Let's turn to tech. Oracle shares higher in the pre-market after gaining the most since 1992 on an aggressive outlook. Waldemar Szlezak, of the global head of digital infrastructure at KKR, writing the following: "We're living through the largest build-out since the interstate highway system, a $10 to $15 trillion wave to rewire the global economy around power, compute, and connectivity." Waldemar joins us now for more. Good morning, sir.
Good morning.
It's good to see you. Thanks for being here. Let's talk about these demand numbers. The demand we're seeing is real.
Yes.
Yet there is still this conversation about a monster misallocation of resources coming together. Where do you stand on that?
It is really the right question to ask. We don't see it, honestly. I think if you look at the fundamental spend relative to any other indicators from a bubble stand perspective, right? I mean, often comparisons are drawn to the dot-com bubble and, other housing bubble, et cetera. It doesn't appear so. And all of that compute that is ultimately being procured is getting consumed and deployed. I think the question that you're sort of leading into is there ultimately a business case for AI to be made? And I think there are a lot of great data points that would suggest adoption is increasing, use cases are increasing, AI is enabling a tremendous amount across the economy and society, generally speaking. But there isn't a killer app, so to speak, that would suggest that the ROI may be justifiable.
I think the issue for many people as well who experienced the dot-com bubble, the bust, and the boom that followed really afterwards, it took a long time to find out who the winners were. And to begin with, you had to have everyone throwing money at the wall to see what sticks. And if we go through this process now, there are risks involved in that. How do you navigate some of those risks at the moment?
It is again, another excellent question, which you would expect on a morning show from you guys. But I think, our approach at KKR has really been pretty simple and disciplined, right? I think we clearly are one of the leaders in digital infrastructure and in the power ecosystem, totality about $65 billion of capital that we've invested in that over the last few years. We have seen the convergence of those two mega themes, which is really interesting. I think we talked about this on the previous show, and I think it's now really applicable. You're seeing data centers are no longer about racks, it's about watts and megawatts of power compute, right? They're AI factories. And I think that convergence is really in place. So I think for us, we've been focusing on core and core plus markets for most of our compute. This is where ultimately data is being generated and processed by users. We focus on high quality customers. We do not chase yield on very speculative business models. I think we focus on fungibility in the use of these assets. It may have been enterprise 5 years ago. Today it's cloud, tomorrow AI, whatever may come next. And we ultimately are not making bets on field of dreams sites. It's really trying to focus on things that if there's a contract, high quality counterparty, we start building and deploying capital against that. That may be, all of that seems logical, but I'm not sure that's universally adopted in the industry, and I think we differentiate ourselves in that approach.
I guess that one of the fears, and John was alluding to it, is this idea that everyone gets incredibly leveraged to a couple of key names and makes really big bets for a long-term development at a time where we don't have a great deal of visibility into how this is going to be adapted, how this is going to be really transforming the economy, and frankly, the way that we live our everyday lives. So how do you hedge that concentration risk at a time where what you offer is the balance sheet to really deploy to these big blue chip players?
Yeah, I think you're right. It is almost a barbell strategy. I think if you look at the market and if you look at the performance in the haves and the have-nots, it's been sort of that barbell view. And certainly the Mag 7 are such an incredible driver of the growth. 30% of the US spend on sort of AI is driven by those three names. $700 billion capex, 35% year over year. That's, by the way, $700 billion is equivalent to the entire spend for the fiber build out in the 90s. And we're now spending that on an annual basis, which is sort of incredible to think about the quantum of dollars. And so I think if you look at certainly the Mag 7, all of those names, pristine balance sheets, incredibly free cash flow generative, right? I think we are looking at certainly trading multiples and PE ratios and spend, but they're not overspending relative to the free cash flow that they're generating from either their existing core businesses or the convergence of AI integrated within their sort of existing business models. So you're right, you have a customer concentration, but the customer concentration is in fact with the highest quality names that you would probably want to do if you're investing in infrastructure from our point of view.
Where is the concentration in investment when it comes to data centers versus energy production? And this is another sort of key question at a time where people are building data centers as quickly as they can, with a question around DeepSeek and whether we can do this more efficiently with smaller data centers and less energy. And then we don't have the energy to actually fuel those data centers that are getting built. So where do you sort of stack up on sort of the dissonance between the development of those two?
And this is why it's such a wonderful time to really be alive and doing what we're doing. And certainly, an infrastructure investor wouldn't think about being in such a growth, industry. But it's really incredible. I think if you look at a couple of stats, we certainly have had stagnated sort of demand growth in the U.S. and the power industry for the past 20 years. that is now in a massive inflection point. Globally, the expectation is that data centers will consume something like 10% of global power in the next 10 years. By the way, that's equivalent to India by 2030. So if data centers were a country, it would be third after China and US. So certainly power consumption is decreasing. There are a couple of dueling factors. You do have efficiency, which is certainly driven by chip manufacturing, by algorithms, which is incredible. That's ultimately driving the cost of the delivery of the compute. So just in 18 months, if you think about the tokens which are being used for AI, I think of it, training for a marathon, we talked about it earlier, it's calories for AI. Token price has decreased 280x over the last 18 months, which means the adoption is increasing. If you look at about token usage, it's increased 4,500%. So certainly usage is increasing. I think if you just go back to your question, I think most of the capital today is being spent on data centers, and then there is an increased capex being put in grid and certainly power generation. So we're starting to see that trend line actually converging. But in terms of growth on an adjusted basis, it's really been those two that are probably the biggest drivers of the capex.
Is deregulation and getting rid of some of the red tape that comes when you have to make these AI data centers actually keeping up, though, with that capex spend you're seeing?
It is really interesting because sort of from a policy perspective, there's two dueling factors that are the collision course. One is win the AI race globally, and the second is protect the ratepayers, which, in the US over the last 5 years, we've seen about 25% increase in power prices. And I think there are a couple of things that are happening, and including, I think, elimination of some of the red tape and streamlining of approvals. And I think those are great things by the administration to help enable the build out of this infrastructure. You can't just turn power on overnight. It's a 4 or 5 year cycle to build this infrastructure. And I think that is a great step towards that. Now, we're even cutting through the red tape, that is helping solve things 3, 4, 5 years from now. We have a gap in the next 24, 36 months. So what can be done? I think we can optimize the grid. There is dynamic line rating. There is investment in superconducting cables, which minimizes the loss. There are all sorts of innovative solutions, like the one we just deployed in Texas, where you co-locate a data center with a power plant. You have a way to effectively augment and draw electrons from the power plant. You have a way to support the grid in cases of emergency. And I think innovative solutions like that will help bridge us into the next phase when we see this massive development cycle of most likely natural gas power plants. And of course, at some point, we'll talk about nuclear. And nuclear will be 5, 10 years from now. I think that's the long game from a carbon efficiency and just the general efficiency of power generation.
There's a feeling on Wall Street right now, they're scared of this. They're saying maybe it's gotten over its skis. You travel to Silicon Valley, and there's just absolute abject euphoria. Can you bridge that gap, the idea that everyone's trying to poke holes over in New York and in San Francisco? People are just running around saying we can't invest enough?
It is interesting. I do spend time on the West Coast quite frequently, and it's incredibly energizing when I'm there and coming back, and you sort of have this wet blanket put on you in terms of all the skepticism. But I do think that there is a bridge there. I think there is now, a bridge in understanding of, certainly I think the technology mindset of, move fast and break things has to come and somehow be bridged in terms of building of this infrastructure, which is really a very different investment cycle, very different risk cycle, and a very different cost of capital cycle. And so I do think that we're helping bridge that gap in saying this is incredibly obviously exciting, but you have to obviously capitalize this in an efficient way. And by the way, the quantum of dollars that we're just discussing, whether it's $10 or $15 trillion, the annual spend, requires all sorts of different innovative, creative, and sort of holistic solutions to help build out this infrastructure. I mean, Oracle's earnings yesterday, which you touched on earlier this morning, were just terrific. It's incredible to see that. So you have $500 billion of backlog, and then the news this morning, that's another $300 billion of backlog. The numbers are starting to sort of seem silly. We're moving from billions to trillions. And that amount of infrastructure will require many, many gigawatts of power, many, many gigawatts of compute. And that's why you see, power companies move up on that news. You see the chip manufacturers move up on the news. You see data centers move up on the news because it just suggests that we're still in very early innings of that investment cycle that is taking place.
You'll have to forgive any skepticism around this table. We want you back soon, okay? It's good to see you.
I love it. Thank you.
Thanks for dropping by. We appreciate it. Waldemar Szlezak there of KKR. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thank you. UBS CEO Sergio Armotti says the impact of global tariffs on the U.S. economy and Federal Reserve monetary policy remains unclear. Armotti told Bloomberg, quote, "In the U.S., we still believe that growth will be there, but the inflation question and how it plays out into the central bank's policies remains open." UK Prime Minister Keir Starmer has removed Peter Mandelson as Britain's ambassador to the United States after new revelations about his ties to disgraced financier Jeffrey Epstein. Mandelson referred to Epstein as his, quote, "best pal" in a book of tributes to the convicted sex trafficker. Bloomberg also reported that Mandelson told Epstein, quote, "I think the world of you," after his arrest. Used car seller and subprime lender Tricolor filed to liquidate in bankruptcy as prosecutors are looking into fraud allegations. The company didn't give a reason for its collapse in the filing, but Tricolor's Chapter 7 bankruptcy petition claimed liabilities between $1 billion and $10 billion and assets in the same range. And that's your Bloomberg brief. John.
Vonnie, thank you. Appreciate it. More from Vonnie in the next hour in about 30 minutes' time. Up next on the programme, counting down to CPI.
Here we are over 4 years into inflation being above the Fed's target for a long time. Businesses kind of getting used to inflation being high. Consumers might be getting used to inflation being high.
Up next on the programme, Joe Davis of Vanguard, live from New York City this morning. Good morning. Equities all-time highs on the S&P 500, record highs on the Nasdaq 100. The run continues. Equities up this morning by 0.2% on the S&P. Similar move on the Nasdaq this morning. Under surveillance this morning, counting down to CPI.
We still have a lot of additional inflation from tariffs in front of us. Here we are over 4 years into inflation being above the Fed's target for a long time. Businesses kind of getting used to inflation being high. Consumers might be getting used to inflation being high. It would be premature to cut 75 basis points for sure and even 50 basis points. I don't know from my judgment that it balances the risk between slow growth and inflation.
So here's the latest this morning. Investors are awaiting today's CPI print after a cooler than expected read on producer prices. Joe Davis, the global chief economist at Vanguard, writes in the following: consumer prices are likely to absorb tariff pressure more slowly than initially expected, with inflation peaking in 2026 and largely subsiding within months, not years. Joe joins us now for more. Joe, good morning, sir. Just frame that view a little bit more.
Thanks,
Give us some more detail if you can. Why is the runway this time going to be a lot longer instead of the pass-through, the immediate pass-through that some people imagined?
Well, again, just the tariff rates have been delayed. The effects are not dead. They've just been delayed. They're starting to pass through the system now. And so, even these questions of what the Federal Reserve is going to do, we're in a little bit of a unusual territory where we're likely going to have inflation year over year rising, yet you're going to have a Fed very likely easing this month. And so that's the cross currents we're going to be talking about. And it comes down to the labor market.
Joe, do you think the Federal Reserve and the way Chairman Powell set things up in Jackson Hole, this is a Federal Reserve that's prepared to ignore those hotter prints further down the road?
I think for a time. Again, we're at stall speed in the labor market. We do not have a recession, but the fact is you have hirings that have just flatlined. I think that's a legacy of the policy uncertainty, particularly from the tariffs 4 or 5 months ago. We were actually head-scratching why we weren't seeing more of a labor market slowdown, but clearly we're not head-scratching anymore, and neither is the market. So I think the Federal Reserve, this is around risk management. At the end of the day, I think they're going to lean dovish and assume that the tariffs are more of a one-off price increase and not something of a longer-term trend.
If that's the case, and you think that that's maybe incorrect, Joe, longer term with respect to inflation, is 3% the new 2% when it comes to the Fed, and do market participants have to kind of think of things that way?
I wouldn't put it that way. There's always a prospect for a policy mistake. We're not in that territory yet. I think, what would be more concerning to me is if we have the labor market, not just kind of flatlining from here, but not downturning. In other words, hiring and firings don't continue to worsen. If that were the case, and yet they were then very aggressive in the easing, let's say 50 basis points at a meeting, another 50 basis points, that would then concern me. And I think we would see a modest visceral reaction in the bond market, but that is certainly not our baseline. And I think the Fed's going to have to be attentive to that at the back half of the year. And again, clarity on the tariffs and how much is being passed through will be a factor along with the labor market.
How much do you feel like the upper income cohort of consumers has been powering both the spending and the inflation and can continue to, even with a recession among lower income individuals when it comes to a loss of jobs, when it comes to inflationary impacts, et cetera, in a way that could allow things to not feel great, for inflation to remain persistent, but not exactly terrible, falling off a cliff? I guess that's the dynamic people keep talking about that warrants Fed rate cuts, but doesn't necessitate a recession.
No, in fact, I think it's a really good point. Sometimes it's not talked about enough. You have the upper income households, as well as businesses, particularly in the large cap space, really powering growth. We have seen it at times before, but it's actually pretty strong. And given what the equity markets and financial markets are doing, it's tough to see that stalling at any near term. So I think, again, we're going to have this. We're going to have these cross currents. You look at some measures, it seems consistent with a recession and a stall. Yet you look at other measures, it's, hey, why is the Federal Reserve easing? I think in the balance, the Federal Reserve will look at the labor market for now, but they have to keep one eye on inflation where it may be 6 months from now.
We just had a whole conversation with KKR about the build out of data centers because of AI. How does the Fed grapple with that?
Well, I think they have to start talking respectfully more about productivity and what are the odds of the sort of trend in growth. And then with that, inflation, if it's productivity, over the next 3 or 4 years. I mean, we've done a lot of work on this, as you well know, and it's eye-opening. The prospects of the sort of Federal Reserve consensus forecast for economic growth for the next 3 or 5 years is very low, actually. And it's been an eye-opening insight from us, from our data-driven framework. So I think the Federal Reserve has to start talking in the Jackson Hole type of settings. How much productivity could it be lifting, knowing that this is a scenario that may not occur? The Federal Reserve started really talking about this in the mid-90s, late 90s, and I think we're going to start entering that territory of how strong could it be, and could we have growth without high inflation or easy inflation pressures? And that's, I think, the world that we may start entering.
Thoughtful stuff, Joe. Appreciate it. Joe Davis there of Vanguard, going into the CPI print later on this morning ahead of the Federal Reserve, about a week away. Looking ahead to next week, a GDP forecast shaping up as follows for 26, 1.6%. is for 26. These are the Fed's forecasts. 2027, 1.8%. This speaks to what Joe's talking about. One handle. That's the Federal Reserve forecast for the next 2 years.
This is not exactly some sort of runaway, incredible expansion that would necessitate restrictive rates, right? On the flip side, he also is projecting 3.1% core inflation at the end of this year. So not exactly that 2% level either. The Holy Grail keeps being placed on the big tech players, and the idea of this incredible surge in productivity.
And going into next year, it's not even just that. Steve Chiavarone talking about the fact that there's going to be an economic boom potentially around things like the World Cup. Potentially, we have a Federal Reserve that's really underpricing a number of events that are going into 2026.
Stocks are positive this morning. Record highs yesterday, adding some weight to the move this morning. Up next on the program, we'll catch up with Evan Brown of UBS Asset Management, former White House official Ashley Davis, Tom Michaud of KBW, and Aditya Bhave of Bank of America.
We definitely see more lingering inflation.
That reaction function is definitely more tilted towards the weakness in the labor market as opposed to potential upside, risks from inflation.
I don't think the Fed really set us up for 50.
Given the inflation backdrop, it'll be pretty much premature to start cutting aggressively at this point.
We still have a lot of additional inflation from tariffs in front of us.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. All-time highs on the S&P and on the Nasdaq coming into Thursday. Adding some weight to the move this morning on the S&P 500 up by 0.2. 6-day winning streak on the Nasdaq. We add to it again this morning. We're up by 0.3. In the bond market, unchanged right now. The calm before CPI. The 2-year going nowhere. 354.78. As for CPI, inflation data 90 minutes away. Together with jobless claims, sandwiched between an ECB decision and a Lagarde news conference.
So how much does CPI matter? And I say this at a time when a lot of people used to say that inflation was the most important gauge for a Federal Reserve, depending on when they potentially could cut rates. Suddenly people are saying, even if it comes in at 3.1% year over year, which is what's sort of expected, not a big deal, because ultimately it is a one-time price shock that the Fed is going to look through in favor of really placing emphasis on a labor market that clearly is not very strong.
So as you know, next week's a three-part story. Decision, statement, forecast, news conference. Decision is done. A lot of people just think they'll cut rates. CPI matters for the forecast, and it matters for the guidance you get in the news conference. Does it open the door for the chairman to be a little bit more aggressive about what he can offer, about what they'll do next? Or are they on the back foot still worried? And I'm talking about the committee. Can he form a consensus around the inflation story? I think that's going to be a little bit more difficult compared to, say, a consensus around the labor market.
And how much will the market care? Because ultimately he is a lame duck Fed Fed chair, I should say. And this, to me, really raises the question of how much he can give guidance, especially given some of his flipping and flopping when it comes to some of the previous discussions of where the emphasis would be placed on the unemployment rate, say, versus just the headline numbers figure. And that's flipped around as well.
And what Steve Chiavarone said is, to your point, it's baked in next week. I think potentially there's some that's considering maybe they would go 50. Even Governor Waller was saying I would need to see how bad it is in terms of the weakening of the latest labor market report. But Steve Chiavarone was saying the real debate between this year and next year, is it 5 cuts or 6 cuts? Is it 4? Maybe they have to go bigger. And then to Lisa's point, we're going to have a whole different Fed next year and a different mantra. It is not going to be, the Powell Fed. It is going to be completely different.
You mentioned Steve at Federated. Put it together with Mike Wilson over at Morgan Stanley. There's a theory out there, and this is the bull case, that the worst of the data is actually behind us. And that what we're going to see in the months to come is an improvement, a pickup, a re-acceleration, if you will. That's why they're so bullish going into 2026, because you layer on top the rate cuts, the stimulus that people think that you get from the bill that's just been passed down in Washington, D.C., and you look to a better 2026.
I can get behind that for one reason alone, is because every day we have $200, $300, $400 billion announcements about investments from big tech names. And we haven't even seen the beginning of this. And you start looking at that tangible aspect. The Fed chair is now Mark Zuckerberg. It is not necessarily Jay Powell. And so you start looking at that, and it's what people can get behind rather than this sort of intangible what's going on that people are looking at in the economy.
Jane Fraser told Jumana, not everything is rosy, though we still don't think we're going to have a recession. What clients are telling us, they are acting with confidence because now they have clarity out of Washington. Taxes, tariffs, and deregulation.
I like the idea of Mark Zuckerberg anchoring pay in America. Don't you? That works for me.
Does it?
Yeah.
Well, I mean,
I think based on some of those contracts we've seen.
That's true.
Absolutely.
So you're basically looking for $100 million
Why
not? That would be a problem, though, for inflation. We might be looking at inflation somewhat above 3%.
I'm not sure Mike would be on board. But,
it could raise some other issues.
You can only ask.
He's going to be your personal Fed chair.
Coming up this hour, Evan Brown of UBS with stocks rallying ahead of CPI data. Former White House official Ashley Davis joins us on the political assassination of Charlie Kirk as that rocks the United States. And Aditya Bhave of Bank of America Securities with an update call on Fed rate cuts. We begin this hour with stocks hitting another record high as we await today's inflation read. Evan Brown of UBS writing the following. The Fed is highly likely to cut rates in September, leaning more against downside risk to employment than upside risk to inflation. Evan joins us now for more. Evan, good morning. It's good to see you.
Good morning. Great to see you.
Just walk us through how you think people should set up going into this print this morning, get into next week and beyond.
Yeah, I mean, I think in general, the way the market has been going is how you broadly want to be positioned, which is overweight equities, have a, neutral to slightly overweight position in bonds, if you can, particularly in the front end, just for insurance, right? We are still seeing a weakening in the labor market. The Fed is like I said, focused on the downside risk to employment. And so you have that support there in case things go wrong and kind of bad news turns into bad news for the equity market.
Well, let's define bad news. So a lot of people in markets, as you know, interested in change. Is the change positive or negative? Will the change be positive from here, even if the numbers aren't great?
Yeah, I mean, what we're doing is looking at the second derivative, to your point. So are things getting less bad? And I think in the labor market, this is the key question because, you know, we've seen some softness, but you can make the argument that really the peak softness happened just after Liberation Day, June maybe being the low point for employment. And now as there's more confidence, more clarity on what's happening on the policy side, that you're going to see some pickup. And we see that jobless claims remain low. A lot of other indicators we track, including corporate commentary, have been a lot more upbeat. So we want to be open-minded on both scenarios, that there's, you know, this deterioration in the data that we haven't seen yet, but might, or if we kind of inflect higher here.
I guess that I'm still thinking about what Steve Chiavarone said. If the bad data is behind us, or at least it's improving from here, did stocks ever price in the bad data? Or could we just not price that in then, not price that in the future, prices to the moon?
Yeah, I mean, stocks are looking past
past,
what we've
present,
seen.
and future.
Yeah, exactly. I mean, I think you and I talked about this several weeks ago when I was on, this apparent disconnect between the bond market and the stock market, where the stock market just wants to look past the weakness in the data, and the bond market has been pricing in, you know, a weaker scenario, and that's only gotten more extreme, that disconnect, with stocks going higher and with bonds, rallying in response to the weaker labor market. I think that is the right play. I think that makes sense. And one of the reasons is that it's not just the bond market pricing in a weaker data right now, but they're also pricing in a structurally more dovish Fed when we get the new Fed chair appointment, when there's potentially a new additional governor who joins, who's more dovish in nature than what we're seeing with the Powell Fed, such that if you really get that rebound in activity and inflation stays stickier for longer, is the Fed necessarily going to respond with less dovish or more hawkish policy? And I'm not so sure that they will. They'll be willing to let the economy run hotter for longer. For now, the equity market likes that.
Well, right now, I wonder how much the equity market and the bond market are actually tied together at all. I'm thinking still about Oracle and what came out, and this idea of a 34% rally in one day, adding more than $200 billion of market cap. That's more than a Disney, almost two Disneys, in one day to one company on the heels of what seems to be an investment cycle that has legs. Is the pain trade still higher in equities regardless of what happens in the underlying economy?
I do think the pain trade is still higher because, actually, interestingly, we track a broad amount of measures of sentiment and positioning. And even as the market has continued to go higher, actually some measures like AAII have been coming down. Like there's the positive sentiment is being outweighed with more people actually thinking that stocks will go down. And so, there's still this underlying skepticism, which we don't normally see. Normally, we see the market go up, people get more optimistic. But we're actually seeing more concern, more, conversation of, is this a bubble and whatnot? Maybe I should be paring back. I don't want to jump right in here at these valuations. That is all the recipe for a pain trade that goes higher.
So what do people do in terms of the hedge?
Yeah, so I think on the growth side, the natural hedge is bonds, but critically more towards the front end, which we've seen. The long bond is kind of broken, not just in the U.S. but globally, given fiscal deficits and concerns about just it's hard for politicians to do fiscal consolidation. We're seeing that UK, Japan, and France certainly, and in the U.S. as well. So. But on the front end of the bond market, I think that's a key hedge. And then gold has just been a really, really important hedge on this idea that you've got the fiscal concerns, you've got concerns about a Fed that may be a little bit more politicized, and this idea that things run hotter and the Fed's not quite responding. At some point, that might start weighing on the equity market. might start putting more upward pressure on long-term bond yields as well. And so gold is playing a critical role in hedging portfolios.
When you say politicized Fed, do you mean what is going on with Governor Cook, with Steve Myron? But we know what those individuals have and in a position. So doesn't the market have at least that level of transparency with what is actually happening with individuals that sit on the FOMC?
Yeah, so we have what we have seen so far, which in itself is not overly alarming in terms of Fed independence risk. I mean, yeah, we know that Lisa Cook is generally dovish and Steve Myron is going to be very dovish, but either way, we're going to get a cut next week, and that's the case. I think the risk, which I think a number of steps need to happen to get us there, is if you get a situation where the Fed Board of Governors, which has leaned more Trump appointed, starts, being influenced in terms of the certification and renewal of reserve bank presidents, because those have been the ones, and there are 5 of those voting on the 12-person FOMC, who have tended to be leaning more in the hawkish or less dovish direction. I don't think that's base case at all. I think we can trust that Chris Waller and Bowman are going to be focused on maintaining Fed independence, but that is kind of the risk where you get more concerned about that scenario.
Evan Brown of UBS, it's good to see you. Bullish on stocks, bearish on the dollar, and likes a little bit of gold, and he's not alone based on the performance this year.
A lot of people are looking at inflation remaining just above that 2% level, Fed being dovish in spite of some of that inflationary pressure, leading to maybe a depreciation of the dollar, but the stocks to the moon story isn't over, and that's what we keep hearing. And the wet blanket of New York City and the skepticism only gives people more confidence in that. So that's what we keep hearing this morning.
How'd you throw New York City into this? Where's that coming
from?
from?
I keep thinking about Waldemar Szlezak, and he came on and he said, he'd been traveling a lot, right? And in New York, everyone's like, this is a bubble, it's terrible. And then he goes to San Francisco, and we're like, oh my God, it's going to change our world. And it's sort of squaring that circle. And, we're living in the wet blanket.
Right to be skeptical of these things now?
100%. I think that inherent skepticism is the reason why Evan's talking about the pain trade being higher, right? How much are we really imagining a world in which a robot is telling us what to do? I know that you think that I'm not going to listen to the robot,
You're not.
But I'm definitely going to be very nice to that robot so that when I am lesser, they treat me
You'll
nicely.
reprogram it so it says what you want to hear.
Yeah. You are great. What
That's
would
it.
you like?
You are great, I can tell you.
Aww.
Okay. Let's get you an update on stories worldwide. Let's get to your Bloomberg brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. A search is underway for the killer of conservative activist Charlie Kirk. Kirk, the founder of Turning Point USA, was shot as he was speaking to an outdoor crowd at Utah Valley University. The 31-year-old was a close ally of President Trump, who posted about the incident on social media and ordered American flags to be lowered to half staff until Sunday. President Trump's pick for a Federal Reserve governor is facing his final hurdle. A full Senate vote on the confirmation of Stephen Myron could come as soon as Monday. The move sets Myron up to be seated on the Board of Governors before next week's FOMC meeting, potentially. OPEC Plus is boosting output and continuing to revive production, according to the IEA. This as record oil supplies are projected for next year and maybe even looking bigger. The IEA anticipates a massive global surplus of roughly 4 million barrels a day in the first half of 2026, with supply set to exceed demand substantially. And that is your Bloomberg brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, political violence rattles the US.
I am filled with grief and anger at the heinous assassination of Charlie Kirk. My administration will find each and every one of those who contributed to this atrocity and to other political violence.
Up next, we'll catch up with the former White House official, Ashley Davis. It is the last big data point before the Federal Reserve meeting next week. It's CPI. It's later this morning, 8:30 Eastern Time. We get jobless claims too, so another read on the labour market, and then a view from the ECB in Frankfurt, Germany. That decision drops at 8:15, and we'll have a news conference with the ECB President Christine Lagarde at 8:45 Eastern Time. So that's how we're set up. That's the schedule for today in financial markets. The scores look like this. Equity futures on the S&P 500 adding to yesterday's record high, up by 0.2% on the S&P. Similar move on the Nasdaq 100, higher by 0.26. And the surveillance this morning. Political violence rattles the US.
I am filled with grief and anger at the heinous assassination of Charlie Kirk. My administration will find each and every one of those who contributed to this atrocity and to other political violence. It's a long past time for all Americans and the media to confront the fact that violence and murder are the tragic consequence of demonizing those with whom you disagreed.
So here's the latest this morning. Investigators expanding their search for the killer of conservative activist Charlie Kirk. With the latest, here's Tyler Kendall. Tyler, shocking news yesterday evening.
Absolutely shocking, John. And the shooter is still at large. We've learned that the FBI is working closely with state and local law enforcement on the investigation after officials said that around 12:20 p.m. Mountain Time, a single shot was fired from a building about 200 yards away from where Charlie Kirk was addressing this crowd. And officials believe that that shot was fired from the rooftop of that building. Now, there was closed circuit surveillance footage that was released that shows a figure in dark clothing believed to be the suspect, but at this point we haven't gotten any additional details, including what potential weapon was used and whether or not it was recovered. Utah officials did say that they took 2 people into custody yesterday but released them after questioning. We know that there were more than 3,000 people at this event at Utah Valley University, alongside 6 local police officers and Kirk's own personal security detail that were on the scene. Now, we did hear from the Utah Governor Spencer Cox, who would describe this as a targeted and political assassination. Of course, Kirk was a prominent conservative activist, a very staunch ally of this White House, of President Trump, Vice President J.D. Vance. In fact, the president was one of the first to confirm that he had died. And it comes against this broader backdrop of heightened focus here in Washington when it comes to the rise in political violence. In fact, we just had House Speaker Mike Johnson last week point to a 55% spike in threats called in against members of Congress in just the last year alone. John, here at the White House, President Trump has ordered flags to half staff across the country through at least the weekend.
Heartbreaking. Tyler, thank you. Tyler Kendall in Washington, D.C. To extend this conversation, joining us now is the former White House official, Ashley Davis. Ashley, welcome to the programme. A dark moment for this country. A lot of people have described it that way in the last 24 hours. How can law enforcement meet this dark moment?
Well, first of all, it's a sad day in this country, and also the anniversary of September 11th, 24 years. So there's 2 different sad days today. But the issue with Charlie that is a little bit different for most White Houses is that this is a personal friend to this administration and this family. Both sons of the president have been friends with him for years. And a lot of the White House staff, as well as staff in the various agencies and senators and House members on the Hill. So this is pretty personal, which is a little bit different. Also, from what I've been told, is this is bringing back tons of memories, almost the same type of setup for when President's life the assassination was attempted on his life. It's bringing back a lot of bad memories for the White House and White House staff. So it is a little bit different of a situation. Listen, there's been political violence that has spiked. I kind of not just blame it on this, but think a lot part of it is the fact that we have the 24-hour news cycle. We have all this social media and all this access to information that can be very, very polarizing. And the algorithms that, if you believe in one way, the algorithms will chase you that way and vice versa on the other side. So, but this has been, listen, my dad said to me, this is my son's day, like JFK. He'll remember where he was, just like my dad remembers where he was when JFK was assassinated. But it has to stop. This started with Steve Scalise. Obviously, Brett Kavanaugh had an attempt on his life, Gabby Giffords, the horrible murders in Minnesota, Nancy Pelosi's husband. I mean, this just goes on. And I don't know the answer to it. As Governor Cox said last night, how do we stop it? We don't know, except for trying to bring the rhetoric down.
Having been in the room, though, what kind of action do you think we could see almost immediately when it comes to either Homeland Security or law enforcement in this country?
I mean, I think that's obviously, I think there's going to be heightened alerts at with Homeland Security. But the problem is when you have a situation like he did yesterday with 3,000 people in open air areas, how do you control all of it? Charlie Kirk does not have the ability to bring a Secret Service level of security. Listen, on your show plenty of times after the president's assassination, I was pretty tough on what happened and the Secret Service not doing their job. But Charlie Cook and other politicians do not have that level of security at their access. So it's going to be, Charlie had, I think from what I understand, 8 security of his own. The local people have been, we're working with his security in regards to trying to make sure that something like this doesn't happen. But I just don't know how you secure places like this unless the death threats to you are so significant that you just try to do things inside, which is just a sad day for our country if that's what we have to do.
It's horrific. And understanding Washington, D.C., could this be a moment for change, for seismic shift in rhetoric and how politicians and as citizens speak to each other?
Listen, I hope so. I thought so as well after the president's assassination attempt. I think that lasted maybe a week that people stopped. You saw what happened potentially on the House floor yesterday with Republicans and Democrats fighting even over a moment of silence that was requested for Charlie on the House floor. So hopefully people reflect on it today. I actually thought that Speaker Johnson gave a good answer to what happened on the House floor yesterday. Was just everyone was in raw emotion. Hopefully everyone takes a step back today and comes back with better behavior on both sides of the aisle.
Other issues right now that Washington is obviously dealing with is, of course, what is going on geopolitically. And I'm focused on what is happening in terms of Belarus and Russia and Poland, saying that they're going to be concerned with what's going on with these Russian drones. Do you have insight on that and how this administration potentially could respond to what we saw this week?
There's 2 things. I actually have spent a lot of time in that area of the world, especially helping with the opposition candidates against Lukashenko in Belarus. And I think that what starts tomorrow is actually something that's very important, which is there's going to be military training in Belarus with Russia and Lukashenko's military. So that obviously is right on the board, right up against Poland. So there's going to be even heightened alert. But it was interesting today. I was looking at how NATO has been reacting, and the fact that they are implementing Article 4 instead of Article 5 in regards to these drones. And Article 5 means that it would be more potential military response. Right now, NATO is reviewing, so to speak, what happened with the drones. I think it lets down a lot of that tension. But it's something significant. And you saw the president's response, President Trump's response yesterday. You have the president getting a ton of pressure from Senate Republicans and Democrats on the Hill to pass 500% tariffs on Russia. So I think that the time is running out in regards to Congress kind of waiting and giving the president the ability to negotiate this. But we'll see.
Ashley, thanks for making time for us this morning. Appreciate your input. Ashley Davis there, the former White House official, on the latest in Washington, D.C. and beyond. The Polish really rattled by the past few days.
Absolutely. They are rattled, and they're negotiating with NATO, try to figure out what the response is to be, to her point, Article 4. Not just yet Article 5, but still a pretty strong moment.
If you are just joining us, welcome to the programme. Stocks positive this morning by 0.2%. Up next, we'll catch up with Tom Michaud of KPW on the outlook for financials. Plus, Yahira has your morning movers and a new name on Wall Street, losing steam. CPI 60 minutes away, the opening bell 2 hours away. Equity futures on the S&P 500 positive here by 0.2%. 3 days of gains on the S&P, 6 days of gains on the Nasdaq 100. Record highs here on the S&P and on the Nasdaq 100 too. In the bond market, 2-year, 10-year and 30-year bond yields still very close to the lows for the year. 354.57 on twos, down about 40 basis points since early August, just before we got that very weak payrolls report for the month of July. That was followed by another weak payrolls report, and it set us up for rate cuts for September and beyond, for 25 and 1 into 26, based on the views of many of you. On a 10-year bond yield this morning, just about unchanged, just north of 4%. Let's call it 4.05 so far this morning. That's the price action in stocks and bonds. Let's get you some morning movers as we count you down to the opening bell. Here's Yahira. Hey, Yahira.
Hi, John. It's a pretty quiet day heading into that CPI print, but worth noting, Oracle again, shares are higher, nearly 2% here in the pre-market after that 36% surge yesterday, marking its best day since 1992. It was also a big day for co-founder Larry Ellison, with Oracle's major rally giving him the biggest one-day wealth jump ever recorded, making Ellison briefly the world's richest man yesterday for a few hours, topping Elon Musk. Next up, we have Klarna. Shares are lower 2%, but the buy now, pay later firm had a strong debut yesterday, surging 15% after raising $1.37 billion. And even though we are seeing the IPO market warm up, Klarna is worth noting it is a 20-year-old company, underscoring this idea how companies are staying private for longer. And we end on Open Door Technologies. The online real estate firm is surging here in the pre-market after some big moves at the top. It has a new CEO who was formerly at Shopify, and its co-founder is back as chairman. Investors are clearly liking the shakeup after some drama last month when CEO Carrie Wheeler was forced to resign after some pressure from investors. John?
Yahira, thank you. More from Yahira in the next hour. On a radar this morning, a manhunt is underway after the assassination of conservative activist Charlie Kirk. President Trump calling his latest act of political violence a dark moment for America. Elsewhere, a full Senate vote on the confirmation of President Trump's Fed pick could come as soon as Monday. The move setting up Stephen Myron to be on the Board of Governors before next week's FOMC meeting.
How important is his voice? And I think this is actually a key question if he is on the Board of Governors next week, given the fact that his term expires, or would expire, should he be confirmed, early next year. Is he representative of what the next Fed leadership looks like, or is he a placeholder to rattle feathers on the Board of Governors? And ultimately, I think people are going to be asking this question next week.
Well, speaking of leadership, let's talk about the future leader of the Federal Reserve. This from the Wall Street Journal this morning. The Fed chair race gets a dark horse. In any other times, this wouldn't be a dark horse. This would be the front runner. Federal Reserve Governor Christopher Waller warned publicly that private sector hiring was near stall speed and flashing red back in July. And a colleague turned around to him and joked, "Come on, Chris, you're a better economist than that." And Chris has been proved right.
And a lot of people are coming to around the idea that he is a good economist, so he would have the market credibility behind him as well. So how much are some of the administration officials who are looking for the next Fed chair, I'm thinking of Scott Bessent in particular, going to be looking for someone with that credibility who also are skewed to cutting rates further?
Well, we know that the Treasury Secretary is in the middle of having these interviews, and he's going to give the top three to the president. The president already says, yeah, the top three kind of sound like what you all have been talking about. And Governor Waller is one of them, and also the Kevins. When it comes to Governor Waller, he has been absolutely vindicated. What Jay Powell said at the last FOMC meeting versus what he said 4 weeks later at Jackson Hole, where Lisa was completely different. And it was like Chris Waller actually wrote that speech for him.
How do you think the Kevins feel about being called the Kevins? It's like the Kevins plus Chris.
Who gets the rose?
Yeah.
Is this going to be or sort
I
of...
imagine Walsh is pretty offended by that.
You think so?
Yeah, I don't think that guy wants to be a Kevin.
You think that like Kevin Hassett is like, you think that he's okay with it?
Should be happy he's just in the running, no?
Wow.
Wouldn't you be thrilled by that?
I don't know. I guess that you always want to be an individual and recognized for who you are as a human being.
Exactly.
And so, Kevin's...
Let's do better.
We're going to do
Walsh and
Hassett.
There you
the
go.
Kevins.
Plus Waller. Kevin's is easier, isn't it? OK. Here's the latest on New York. New York Governor Kathy Hochul stopping short of an endorsement for New York City mayoral candidate Zohran Mamdani. Hochul saying she would work with the Democratic Socialists despite their philosophical differences.
I don't want to raise income taxes on high net worth people. I'm a staunch capitalist. And so I need to know that people can have a certain philosophy, but you got to govern in reality. And the reality is that this is the financial center of the world.
I don't want to raise income taxes on high net worth people. The big headline in that interview.
Yeah, how much is she going to push back and stymie any goals should Zohran Mamdani win the mayoral race? And it seems like she's lining up to do so, given the fact that the state ultimately has the power over the purse in terms of taxes and how much you can raise them. A real question here of how you parse the fact that the issues that are being raised are relevant and important. It's the methods of how you go about it that really are the controversial ones, and that seemed to be the needle she was trying to thread.
And she hasn't endorsed anyone just yet, but we've heard from this from her before in the past. She said, I can't lose any more people to Palm Beach, talking about the fact that taxes cannot continue to go up to New York, and you think you can attract high net worth individuals and talent, because guess what? At some point, they are just going to leave.
It's the financial capital of the world. You know, you've got to respect that. Let's stay on the financials. Citigroup CEO Jane Fraser telling Bloomberg she sees a pickup in activity with no US recession on the horizon.
I still see very strong pipelines. I see high level of engagement from clients. I see a sense of urgency as well, active in the capital market arena, in financing, much more active in investing, less sitting on the sidelines. And M&A has been very, very active indeed.
Let's turn to Tom Michaud of KPW, a Stifel company, for more. Tom, welcome to the program.
Good morning. Good morning.
Before we talk about this, let's just talk about what day it is. You were headquartered in the World Trade Center, lost 67 people that day. I want to spend a few moments with you just to think about what that day still means to you today and how we ensure that this generation that's now coming onto Wall Street, who weren't alive that day, hadn't been born, how we make sure they don't forget either.
Correct. Thank you. Yes, we think it's very important to not forget. We said that day we were never going to forget. And there have been a lot of big pieces to what never forget means, because never forget means different things to different people. One of the things that we're doing is making sure that 9/11 isn't defined just by the people who flew airplanes into our building. Instead, I'm working with a group, 911day.org, which is a group that KBW helped found, to think about the resilience and the goodwill and the rebuild and honor the victims of that attack with that spirit. So we worked with Congress, and in 2009, we got Congress to pass a law making 9/11 a national day of service. And we think today there are going to be 33 million Americans who participate in a day of service to remember the victims of 9/11 and to remember the resilience and to remember the goodwill that it took to rebuild. There is one service project in particular that we support. We're going to be in 24 cities in America today. We're going to pack close to 9 million meals for those who are food insecure. We have over 800 corporate customers. It's our corporate partners in this. Next year, our aim is to try to double that for the 25th recognition and anniversary of 9/11, to continue to talk about what it took for America to rebuild after the attack. So you don't end up with 9/11 being 2 paragraphs in a history book. We're not going to let that happen.
You're contributing to a lasting legacy and making sure it's a positive one. So I think we're all right behind you, sir. And thank you for being with us today to talk about it. We need to talk about the broader business world too. We need to talk about what's happening with banking activity. Things are bouncing back. And you can see that and hear it in the words of Jane Fraser of Citi. Are you seeing that too?
So I've been a guest on your show many times over the last couple of years. The factors that were headwinds are now tailwinds. I'm about as optimistic on the fundamentals of the banking sector and financial services in general as I've been in several years. There's revenue growth. There's earnings per share growth. We're looking for 10% this year and next. The economy's okay enough. So that's all very bullish. And then there's the other stuff, which is rather than regulatory attention slowing down financial services, it's now resetting to where it typically is, which is one that's more supportive of growth. So the consolidation is going to restart in the industry. And the other thing is I heard you talking earlier about how the market's at an all-time high, 6 straight days, I think, in the NASDAQ of records. The reality is you don't have the downside risk in the valuation for the financials. While the stocks have done well, they're still well far away from their historic norms. There still is a lot of valuation upside in the financials. And my experience is that when earnings estimates are going up, profitability is improving, the stocks tend to do well.
There's a lot to unpack there. I want to just hone in on the idea of the mergers and acquisitions. We have seen some of those announced in recent days, the PNC one coming just a couple days ago. Where are we in this process. How much more of that do you see in the next 6 months?
So my opinion is we are approaching the end game. There are 140 banks in America north of 10 billion in assets. 96% of the banks in America are below 10 billion are community banks. 96% of any number is almost all of it. There are very few banks above 10 billion. And I think the bigger banks are beginning to think about what the end game is going to look like. And they're being very strategic in thinking about these acquisitions. In the previous administration, it had an anti-M&A bias and wouldn't even give an answer to bank merger applications unless they were forced to. Now the administration's gone back to what historically had been the case, and they will give you an answer to a merger application. That's all the industry needed to restart the consolidation wave, and it's underway right now.
So what does it look like in the end? Is it just a couple of sort of the megas and then the sort of media megas and then everyone else?
To take the funnel real quickly, remember the non-banks. You were talking about Klarna earlier. Financial banks used to be half of the S&P 500 weighting in financials. Now they're a quarter of it. We think Ares is going to get added to the S&P 500 next. That's a very big $80 billion market cap company. So banks are a smaller piece of the financial services industry. They're competing with Klarna. They need to have the scale and the capacity to do that. Otherwise, the industry will evolve with 4 really big banks and then a lot of other ones that are much smaller. The best thing to do for the economy, in our opinion, is to allow these regional champions to get the scale to compete with the big 4 banks and then compete with non-banks. And I think our economy and Main Street America will be better served if that happens.
You sound incredibly optimistic about bank stocks right now. How hinged is that to a reacceleration in the underlying economy versus a secular shift?
Let me talk to you about the one thing that can stop it. The one thing that can stop it is credit quality. So this past week was the Barclays conference in New York. It was the last big channel check we get for the quarter. Everybody's saying the same thing. Credit quality continues to remain pristine. The industry is over-earning on credit at the moment. It shouldn't always be this way. So there will be a moment where credit costs go up. That shouldn't be the surprise. The surprise is for how long it's been essentially zero. So as long as we have a solid enough economy, then I think the bull story is very much intact. Usually, if we get a credit cycle, investors tend to sell bank stocks first and ask questions later. So the fact of the matter is we don't see a credit cycle on the horizon in the banking sector. So our view is that that is what's necessary, and 1.9% GDP growth is good enough to keep the fundamental story in play. And actually, the banks are talking about accelerating loan growth, which is a positive part of the story.
Can you just remind everyone? It's my favourite stat of yours. Just remind us all of the top 10 mortgage providers in this country now and how many banks are in the top 10 compared to, say, a decade plus ago.
So pre-global financial crisis, 8 of the top 10 mortgage originators were banks. Today, 3 of the top 10 are banks. Now, the question along that line, John, is did banks forget how to make mortgages? They were all primarily founded to make mortgages. And that is regulation, because the response to every crisis is regulate the banks, which tied their hands, which is why the non-banks have so much market share. The right thing to do is to take the foot off the banks, let them compete with the non-banks, and I think you can do it without putting too much risk in the system, because the risk has just gone elsewhere, and it's gone outside the supervisory umbrella, and when we get the next cycle, we're going to find out if we were better off.
Thomas Michaud, got to leave it there. It's good to see you, sir.
Thank you, Jonathan.
Thank you for being here. We appreciate it. Thomas Michaud there of KPW. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. It's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. Boeing has reached a tentative agreement with striking hourly workers at its St. Louis area factories. The company says the 5-year contract offers expanded wages by an average of about 45% and provides a 24% average guaranteed wage increase. Workers will also receive a $4,000 ratification bonus. Union representatives are set to vote on the contract Friday. Mexico is planning to impose as much as a 50% tariff on cars and other Chinese products, aligning the country more closely with U.S. protectionism. The move comes as President Claudia Sheinbaum prepares for talks over North America's free trade deal. And Chipotle is venturing into Asia. The fast casual chain has plans to open locations in South Korea and Singapore next year. Chipotle's CEO says he expects international markets to become the next layer of growth beyond North America. And that's your Bloomberg Brief. John.
Hey, Vonnie, appreciate it. Up next on the programme, don't fear the pause, fear the cuts.
Don't fear the pause, fear the cuts. They have to do a preemptive insurance rate cut. What they don't know is the trajectory of what the impact of labour market softness is going to be on consumption.
That conversation up next with Aditya Bhave of Bank of America Securities from New York City. You're watching Bloomberg TV. The economic data is about 42 minutes away. Stocks going into it doing okay, up by 0.2% on the S&P 500. On the Nasdaq, up by a third of 1%. Under surveillance this morning. Don't fear the pause, fear the cuts.
Don't fear the pause, fear the cuts. When the Fed starts to cut rates, a lot depends on why they are cutting rates. They have to do a preemptive insurance rate cut. What they don't know is the trajectory of what the impact of labour market softness is going to be on consumption. And I think that's the linkage that they're trying to, give the market some sense of relief and comfort.
So here's the latest this morning. Investors preparing for the last major read on inflation before the Fed's rate decision next week. Aditya Bhave of Bank of America Securities saying there is now clearer evidence of deterioration in labour demand, and we are changing our Fed call to show 2 25 basis point cuts this year in both September and December. Aditya joins us now for more. Aditya, good morning.
Good morning. Thanks for having me on.
Thank you for being here. This is a change to a long-standing call. You were looking for no cuts in 2025.
Correct.
For a long time, you said there'd been a step down in payrolls growth, but measures of slack had stayed pretty stable. So let's start here. What's changed?
So what's changed is both the reaction function expressed by Chair Powell, which was more dovish than we were expecting, and some signs of weaker labor data. So payrolls have weakened more than we were expected. The unemployment rates moved up, although that was sort of expected. You can look at the ratio of vacancies to unemployed workers. That's ticked down a bit. So you take all of that in the context of the way Chair Powell is talking about the trade-off between concerns about higher inflation and concerns about a weakening labor market, and it does look like the Fed will cut. We still think they'll have to be quite cautious in cutting, so we only have 2 cuts in this cycle under Chair Powell, 25 in September and 25 in December.
The labour market and his approach to it seems to have changed as well. In the news conference a number of months ago, he appeared to anchor his view on the labour market around the unemployment rate. And now that's shifted to payrolls growth. Does that stack up for you? What's behind that?
It's hard to say what's behind his thinking, but I would say we are probably more concerned about labor supply, or we think probably a larger share of the shock that we're seeing in the labor market is a supply story than a demand story, than perhaps the Fed is conceding.
Do you think that the revisions, though, changed the view a little bit? Just the idea that there was that much less momentum when we saw a negative payrolls print in June for the first time since December of 2020?
The revisions are interesting. That's one way to think about it. The other way to think about it is that we grew 2.7% in terms of private domestic demand in that period where the revisions occurred. And there was only 70,000 in job growth per month in that period. So what does that tell you about productivity? Also, what does that tell you about the break-even rate? We might have already been in a world where break-even job growth was a lot lower and productivity is really surging.
This is a fascinating point, and it's the reason why a lot of people are saying maybe the weakness is behind us. Maybe the weak data already occurred and we're heading to some sort of reacceleration. Do you think if the Fed cuts into that, it becomes a liability from an inflation perspective? Or do you think that this is a new paradigm with a productivity overlay that we really are not counting enough?
We've been concerned about inflation for a while. Not necessarily the impact of changes to trade policy, but just underlying inflation. We think that's been stuck around 2.5% for a long time now, and the Fed is not willing to concede this. The Fed keeps saying that if X of the tariff impact, we're definitely heading back towards 2%. We've made a lot of progress on the target. I just don't see it. to be honest. And I think, like you said, cutting into a potential reacceleration in the economy, which we are seeing in our consumer spending data as well, the BAC card data, spending by our credit and debit card consumers, everything aggregated and anonymized. We're seeing a pickup. We're seeing a reacceleration. And if you cut into that, then I think that creates some upside risk to inflation.
Is that why we wouldn't see, say, 50 basis points next week, even though some people are calling for it after the weakening labor market report?
It's quite unusual for the Fed to be cutting with 3% inflation, even 25, never mind 50.
Right.
All at once. The inflation report that we're about to get, the chairman said a one-off, but not all at once. I think that's really interesting from this Fed chair, because not only is he telling us he's willing to cut rates at 3%, he's willing to cut rates again, even if inflation prints come in hotter over the next several months. I want to understand what that would do to your outlook for inflation in 26 if this Federal Reserve continues to dismiss hot prints and keeps cutting.
So we're thinking of the inflation trajectory as more of a plateau rather than a mountain. So to the extent that retailers do pass costs through, and there's a big open question around that, but to the extent that they do that, we think they'll be quite strategic, quite slow in doing that. So instead of getting this big spike and then coming back down to target, we think you basically go up into the low threes, and we're almost there already, and you stay there for maybe a year. The question is, what is the path back down like? We have the core PCE ending next year at around 2.6%. That would be with a lot of the tariff effects already rolling off. Is that acceptable for the Fed? And if it is acceptable for the Fed, if the Fed is implicitly raising its inflation target, there's nothing wrong with that, with 2.5–3% inflation from a macro perspective, but it does mean a higher neutral rate, because your neutral policy rate is a function of your inflation target. So then policy becomes even more accommodative, everything else being equal.
So the numbers would actually back up what you're saying, because we haven't had a 2% inflation rate going back more than 4 years. So it raises a question why the market doesn't seem particularly alarmed about this, and why you are seeing break-even rates continuing to be pretty quiet and still around that 2% level.
So here's a fun fact for you. Since the first quarter of 2021, we have never had core PCE inflation on a quarterly annualized basis sub 2% for even one quarter. We've only been below 2.5% a couple times, and that was all used cars. So we're basically stuck above 2.5%. I just don't see how you can look at it any other way.
Aditya, appreciate your take. Thank you, sir. Aditya Bhave there of Bank of America, going into the CPI report in about 35 minutes' time, raising some big questions about what we might see from the Federal Reserve in September and beyond. And the beyond is the more interesting piece of this, 25 basis points. That or 50, I've got no idea. The guidance from there is the interesting piece of it all.
Do they still have a 2% target if the inflation rate is 2.5% or even 3% for 10 years? I guess that if you look out and you say 5 years from now, if it still is above 2% and that's okay, if the labor market's intact, well, then what are we talking about in terms of a target?
Mohamed El-Erian has been talking about this for months, that basically they just need to come clean, that they're actually not targeting 2% anymore. They're basically just accepting it's going to be a 2 to 3% inflation rate.
Months, years. He's been talking about it for years.
You're right.
He said if you were going to set an inflation target of the Fed right now, it wouldn't be 2, it'd be 3. And basically, they've been playing the game as if it was a 3% target.
Yeah, and so we'll see their reaction to today's CPI.
Coming up on the programme, we'll catch up with Greg Boutle of BNP, Pooja Kumra of TD Securities, Tiffany Wilding of Pimco, and David Kelly.
We definitely see more lingering inflation.
That reaction function is definitely more tilted towards the weakness in the labor market as opposed to potential upside, risks from inflation.
I don't think the Fed really set us up for 50.
Given the inflation backdrop, it'll be pretty much premature to start cutting aggressively at this point.
We still have a lot of additional inflation from tariffs in front of us.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The main event, 30 minutes away. Going into it, your scores look like this. Live from New York City this morning. Good morning, good morning. Equity futures on the S&P 500, positive on the S&P this morning, a few tenths of 1%. Likewise on the Nasdaq 100. In the bond market, really well behaved over the last few weeks through September and through August too. Bond yields back down to about 355, up by a single basis point this morning on 10s just north of 4% at 4.05. The data drops in about 29 minutes now. CPI just around the corner, together with U.S. jobless claims.
Yeah, which is going to take precedence at a time where very much the labor market has taken all of the oxygen out of the air. The CPI print, people are going to be talking about the headline number. We're going to be looking under the hood. It matters where any inflation came from. Is it that people are taking airplanes lots of places? Are they paying up for their hotel rooms when they go on vacation? Or is it coming from the basic staples that could potentially be tied to tariffs or other supply disruptions, the good side of things? That's going to matter to give a sense of whether this is discretionary or whether this is coming from another location.
This market has moved on so quickly from inflation prints in America. If you told me back in April, you're going to get inflation in September and nobody's going to care, they're all going to focus on the labour market and the Fed's going to cut rates even if it comes in hot, I've been like, what are you talking about? April 2nd just happened.
It seems like Team Transitory got back together subtly and then quickly and then all at once. And now it's this idea that inflation is no longer a concern. I personally am concerned just about vacation planning as well as eating out that has become incredibly expensive. These are the aspects, though, of life that people do care about. The inflation that does really affect the way people think about their spending power, about their income. And I think it does matter to understand whether the stagflation light was an overstatement or whether that still is a dynamic very much at play.
Chairman Powell in Jackson Hole, Wyoming, talking about a one-off inflation shock, but not all at once. So maybe in the next several months, we'll get a few more inflation reports that come in a little sticky, a little hot. He's setting up this Federal Reserve to basically look through it.
Exactly. You can just shrug it off and ignore the CPI prints if they're hot, because we already know that it does seem like they are anchoring, at least at this moment, towards the weakness in the labor market. We've been talking about how Governor Waller has been ahead of the curve when it comes to this Federal Reserve, and basically the one that pretty much seems like he wrote Jay Powell's speech at Jackson Hole. But it's also a moment of vindication potentially for this White House. Yesterday, after the PPI, that was a downside surprise, and many saying you're not seeing the excessive pressure on prices from tariffs that some were expecting. This White House is feeling vindicated and asking them to go bigger with a jumbo rate cut.
2 data points, 27 minutes away. Inflation data and jobless claims. Coming up this hour, Greg Boutle of BNP Paribas as stocks trade at all-time highs. We'll speak to Pooja Kumra of TD Securities with an ECB rate decision just around the corner, and Tiffany Welding of Pimco as we break down the latest inflation reading. We begin this hour with stocks edging higher as traders await a key CPI report before the Fed meeting begins. Greg Boutle of BNP Paribas writing, risk of a shallow correction post the FOMC decision could set up a Q3 earnings season rally. Greg joins us now for more. Greg, good morning.
Good morning.
This is what a lot of people are thinking about, is that things start to pick up from here. We heard it from Steve Chiavarone of Federated. We've heard it from Mike Wilson of Morgan Stanley that going into year end, you could have some kind of economic acceleration into 26. Are you that bullish?
Yeah, I don't necessarily disagree with that. One of the things we have to think about with things like the CPI is that equities are a nominal asset. So when we think about earnings growth, it is in nominal terms. So if you have the Fed willing to run the economy a little bit hotter, that can be bullish for earnings.
How hot are they going to run things next year? Are they going to stop at 3? When they talk about taking rates down to neutral, do you think they stop at 3 at the Federal Reserve?
It very much remains to be seen. But I think the market's going to trade off the narrative that we have a dovish Fed who is willing to run it hot into the back end of this year. And then those are going to be questions for next year, I think.
You mentioned shallow recession. Did that happen?
So what we mentioned was the idea of a shallow pullback specifically. So what we're talking about here is when we look at this year, it reminds me a lot of 2019. 2019 was a really bullish year for equities, and a big part of that was the Fed started a cutting cycle in July 2019. But when you actually look at the price action, it was very well priced going into the event, and the softest patch that we had that year was immediately after the Fed started cutting rates. So it was a kind of buy the rumor, sell the fact type move. So we think there's a risk here that, this September rate cut is very well priced now. Fed can deliver that, and the market can take a breather.
Which is the idea of don't fear the pause, fear the cut, because this has already been priced in. It raises a question of which stocks have actually gotten the greatest benefit from the idea of an easing Fed. Do you believe that the cyclicals can really be the leaders going forward if there is a rate cutting cycle in the face of a labor market that definitely has slowed down, regardless of what you think in terms of the long-term implications?
Yeah, that's our view, that there can be this rotation. But I do think we have to be a little bit cognizant about which cyclicals we're looking at. Because you can look at things like the small and mid caps that are generally seen as rate cutting beneficiaries, cyclical part of the market. but they've massively outperformed things like the industrials over the last 6 weeks or so. So we think where there could be a catch-up trade is some of the industrial cyclicals. Some of these potential beneficiaries from some of the capex measures in the One Big Beautiful Bill. It's worth looking at the ISM readings as well that we've seen this month. The new orders specifically picking up there. So if you have a Fed who's willing to run things a little bit hotter and you have new orders pick up, we think the kind of industrial, cyclical, old economy parts of the market that do trade at less inflated PEs are potentially interesting.
If you're interested in that sector, though, does it worry you that manufacturing jobs have actually been coming in soft?
Yeah, I think it is a cause for concern. And I think the data is very hard to read at the moment. There have been a lot of revisions. Depending which bits of data you look at, they are pulling in different directions. So that's why I think it's a very difficult kind of market for the data to try and navigate. But I think that it looks increasingly like the Fed is willing to cut or do a series of cuts, which I think for us puts the risk reward on the idea that this could be a soft patch that reaccelerates into next year. So this could be a good time to...
I noticed you put a probability on a 25 or 50. I just want to go there because the administration is pushing for this 50 basis point. You only say it's 10% chance. What kind of CPI print could we see today? Like how soft could it be today that maybe actually you would change your probability?
Yeah, so that probability is more what the market is implying. So if you look at what is implied for the September cut, it looks exactly like what we saw in 2019 going into that cut. So the market is basically pricing this base case that you get 25 bips and it's more of a tail that you could get 50. So our view is that we'll get 25. So that's why I think there's maybe a little bit of room for disappointment. It's not a particularly very bearish call, but it's just more this idea that we've really kind of bought the rumor, sell the fact, and we can just drift lower into what's a seasonally soft patch.
That's one way of looking at it. What if we get a really soft print at 8:30 Eastern time, based on the odds you just gave? Shouldn't that set us up for a bigger move on a weaker inflation print than a larger one?
Yeah, so I think one of the things that we've been talking about from a volatility perspective is that even if we think probabilistically we're more likely to get a shallow correction, the tail risk for the market is actually fatter, we think, on the upside. So when we think about the options market, the part of the options surface that we think is most underpriced is the right tail. If we have a very big and very volatile move, I think that's more likely to be on the upside than the downside. We mentioned things like Russell that have outperformed a lot, the small and mid caps. There's still quite a big short interest in the futures there. So if you were to get a very soft print today and the market read that as driving 50 basis points cuts, that's where the kind of risk of a more volatile
Can I just follow up on that, the right tail risk? I'm surprised by that, given the experience of April, May and beyond. Haven't we been conditioned that upside risk is a massive factor in 2025?
Yeah, but part of that is just how the market trades. You do tend to have rallies, even quite large rallies, happen in a less volatile manner. So you can see the market trending up, say, 25 pips a day, and you can get quite a big move over 1 month, 2 months, 3 months, but it comes across a less volatile backdrop. When you see the market sell off, it tends to be more volatile, up, down, up to, down to, up to, down to. So the way the option surface is looking at the moment, the downside is very elevated relative to the upside. So I think if you're interested in playing that idea that things become more dislocated on the downside, on the upside, and the Fed runs things too hot, the upside optionality is the way to play it.
Then give Greg a call. Greg, it's good to see you.
Thank you.
As always, there's the pitch. Greg Boutle there of BNP Paribas.
Evan Brown agreed with him that the idea of the pain trade being to the upside more than to the downside. And we keep hearing this. Amy Silverman also talking about that, with the idea that people are persistently pessimistic on Wall Street. It seems like, I guess, since 2008, everyone's waiting for the next big short and it never happens. And so people are sitting here waiting and thinking maybe this is it. And yet here we are.
Well, based on the price action of the last few months, I would have thought the FOMO was real. No? Missed out on that kind of rally. Do you want to miss out on the upside if everyone's going around like Greg Boutle talking about upside risk?
Sure. You can make that argument. At the same time, if everybody is super pessimistic and prepared to miss that rally, you start to wonder exactly how things are priced. It just highlights how difficult it's been to price in both the resilience and creativity of corporate executives in order to deal with all of the potential incoming data, the resilience of consumers, and just how powerful the AI story has been in the investment cycle.
Super powerful, based on a move from Oracle in yesterday's session. Equities up again this morning by 0.2%. With an update on stories worldwide with your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. A search is underway for the killer of conservative activist Charlie Kirk. Kirk, the founder of Turning Point USA, was shot as he was speaking to an outdoor crowd at Utah Valley University. The 31-year-old was a close ally of President Donald Trump, who posted about the incident on social media and ordered American flags to be lowered to half-staff until Sunday. UK Prime Minister Keir Starmer has removed Peter Mandelson as Britain's ambassador to the United States after new revelations about Mandelson's ties to disgraced financier Jeffrey Epstein. Mandelson referred to Epstein as his, quote, best pal in a book of tributes to the convicted sex trafficker. Bloomberg also reported that Mandelson told Epstein, quote, I think the world of you, after Epstein's arrest. Former Vice President Kamala Harris says it was, quote, reckless to let President Biden and his wife, First Lady Jill Biden, decide whether he should have sought re-election at age 80. In her forthcoming memoir, 107 Days, Harris says the stakes were too high and the decision shouldn't have been left to an individual's ego. Harris's book is set to be released on September 23rd. And that's your Bloomberg Brief. John.
Vonnie, we appreciate it. Thank you. Up next on the programme, Pooja Kumra of TD Securities with an ECB rate decision. Coming up next from New York City this morning. Good morning.
We're likely going to have inflation year over year rising, yet you're going to have a Fed very likely easing this month. And so that's the cross currents we're going to be talking about. And it comes down to the labor market. We're at stall speed in the labor market. We do not have a recession, but the fact is you have hirings that have just flatlined.
The range of views on this economy is so wide. That was Joe Davis, the global chief economist at Vanguard, talking up the labour market being at stall speed, on the precipice perhaps of recession if you listen to Neil Dutta of Renmag, then others just looking for a re-acceleration. That call on re-acceleration coming almost exclusively from the equity market bulls, but still, super wide range.
Well, it's also coming from people who are seeing mergers and acquisitions, who are looking at the industrial sectors of the United States. It's almost as though you look at housing and you look at certain pockets of consumers and you say, oof, this doesn't look good. And then you look at the rest of the economy and you say, actually, there's something else happening here. And those two are in direct conflict with one another.
8:15 Eastern Time, just got an ECB rate decision, unchanged as expected. The price action going into it and the numbers we get in 15 minutes time. Jobless claims and CPI look like this. We're firmer by 0.2% on the S&P, on the Nasdaq up by 0.3. In the bond market, yields just a little bit higher across the curve stateside. And in the FX market, euro-dollar unmoved off the back of this. Euro-dollar 116.84. Let's head over to Frankfurt, Germany and get you a breakdown of this decision. Bloomberg's Lizzie Burden joins us now for more. Good morning, Lizzie.
Hey, John. Well, this hold was very much expected by economists, by markets as well. The question is whether the ECB is done with cutting, as economists expect, or whether there's another insurance cut in the ECB's back pocket, as markets had expected. So for clues, we're looking at the forecasts here. I'm waiting for the longer-term forecast, but this is crucial because it's the first batch of forecasts since that US-EU trade deal. And, of course, 15% tariffs are higher than had been in the baseline scenario, but not as bad as the severe scenario. They say that they see 2025 inflation at 2.1%. In the previous forecast, they had seen 2%. But what we really are interested in here is the number for 2027. They see GDP growth at 1.3% in that year. Previously, they had seen 1.3%, so exactly the same. But they're raising the inflation forecast for 2025-26 and cutting it for 2027. Now, that's what I was looking for here, because perhaps you could take that as the ECB saying mission accomplished, no more cuts here. Now, crucially, we need to see how hawkish Lagarde is at the press conference. In previous recent press conferences, it has been noted that Lagarde has been more hawkish than the rest of the governing council, or at least what is on paper here. Maybe there is a disparity there. Does she emphasise the uncertainty that this trade deal alleviates, or does she emphasise that 15% is above the base case? I'll be listening for that. There is also the big question of French politics, of course, because once upon a time, Madame Lagarde, as you know, was the French finance minister. Will she say that the ECB would intervene if the oats bundt spread were to widen? Highly unlikely. I don't think she'll want to wade into domestic French politics. But just looking at the euro reaction here, There's absolutely none. And frankly, it may be that CPI print coming in just a few minutes' time does more for the euro than what's happening here in Frankfurt.
We're not here to close spreads. Feels like a lifetime ago. Lizzie, thank you. Lizzie Burden with the latest in Frankfurt, Germany. Some very mild marginal movement on euro dollar. Negative on the session now by about 0.2%. No predetermined path at the ECB. Determined to stabilise inflation around 2%.
Yeah, and it seems like, based on the projections, to Lizzie's point, it looks like not mission accomplished, but it may take some idea of a rate hike off the table for some next year, which was some people were speculating with the ECB. This idea that they increase the inflation expectations for next year, but decrease them for the following one really highlights where they see things going and how they do see this as sort of a one-time shock.
Let's get over to Pooja Kumra of TD Securities for more on this story. Pooja, welcome to the programme. The ECB not pre-committing to a particular rate path. This was widely expected, Pooja. They're forecasting inflation ultimately to stabilise around 2% out in 26, out in 27. Pooja, when you look at things, could that story be disrupted by the trade variations that we've seen already so far this year?
Yeah, as in when it comes to forecast, decision, everything seems pretty much as what we had expected. So far, from ECB perspective, they are basically, it's no longer about tinkering the policy for the disinflation process in Europe area. It's basically about the uncertainties. And when it comes to tariffs, so far, Europe has actually done a pretty good job. We are not seeing the kind of disruptions in terms of growth, PMIs. But I think, can that domestic resilience actually continue when the global resilience is actually being a little more shaky right now? So I think that's where the ECB needs to address whether they are done or there's more to go just because of the global uncertainty. And if the domestic consumption can be as strong as what they are expecting going forward.
Well, Pooja, as you know, there was a very simple story being told after April 2nd and the massive tariffs we saw from the president, particularly the massive tariffs on China, is that China would do very little to address its overcapacity. And because the walls were going up in America, Europe would have to eat it. And that this shock was actually a disinflationary shock for the Europeans when people thought it might be, I stress might be, an inflationary shock for the US economy. Pooja, is that no longer the case looking out to 26?
I think it's definitely the case, and this is something that even the ECB minutes from July have pointed out. We are already seeing signs of good dumping in Europe, along with low oil prices, higher Euro USD. All is basically giving you the kind of inflation forecast that ECB is looking right now. But I think at this stage, they are looking at it as a just one-time shock, and they do not want to be very reactive, just because even we are the middle range of the neutral, and they don't want to remove all the capacity of easing just because of sudden just small little jumps in the system. But this is one of the risks that is being highlighted.
How much does this act as a detriment to growth? And I say this at a time where the economic growth forecasts in Europe are some 1.2% for this year. That's higher than expected. And next year coming in at about 1%, below where previously was expected. Pooja, how much is this no longer a tailwind that the ECB could potentially consider easing, even if they aren't going to necessarily hike?
I mean, there's always a risk, but I think one thing that has changed in the European narrative from the 2018 story that we have lived with tariffs in China is that Germany is ready to spend. They are not holding themselves back, and that's visible in the PMI services. So I think at least the ECB wants to be patient for the next couple of months as how this defense and infrastructure spending plays up. He notes that infrastructure spending has a good multiplier for growth, unlike a consumption-driven expenditure. So I think that's where there are positives in the system that we should not ignore, and I think that's what ECB wants to dwell on. But they can buy another 4-5 months, but after that, if they don't see the German growth picking up, I think the case for easing is still there.
Pooja, this is a forgettable decision. We'll see what actually happens in the news conference. But right now we're looking through, and this is pretty much exactly in line. How jealous is the Bank of England and the Fed that this is sort of something that can fade into the background and sort of be a non-event?
Sorry, I didn't catch you.
Just how unique is this position of the ECB, where they're in a somewhat of a non-controversial position versus, say, the Federal Reserve next week grappling with inflation and slowing growth, while also the Bank of England dealing with the deficit and the overhang there?
No, definitely. I think ECB has definitely got it easy. I think it's more, I think even Fed, when it comes to labor market, they are getting signs. They have a dual mandate. They know how to go with policy forward. But I think for BOE, it's much more tricky when inflation is just so sticky. And even growth, it's actually one of the best performing G4 economies right now. So I think for BOE, it's more of a painful decision that how long can they be actually restrictive? Which is something, when trouble comes to an economy, it comes very quickly. And I think that's what even central banks are right now a bit scared of, because everyone wants a soft landing, right? And ECB did manage to create it. So well done them.
Pooja, appreciate it. Pooja Kumra of TD Securities reacting to the ECB decision just moments ago. Let's go through the forecast from the ECB. So this is inflation excluding energy and food. They expect an average of 2.4% in 25, 1.9% in 26 and 1.8% in 27. If that's mission accomplished, allow me to share with you their outlook for growth. The economy is projected to grow by 1.2% in 2025. The growth projection for 26 is now slightly lower at 1%. The projection for 27 is unchanged at 1.3%. If that's mission accomplished, 2% inflation and a one handle on growth, then Europe's got a lot to do.
Well, and frankly, this highlights how the ECB is a single mandate bank. It is inflation, and it is focused on that, and it might be mission accomplished on that level. It hasn't really changed the trajectory for the European continent, which is the reason why so many people come on and they're saying, yeah, you can increase your exposure to Europe, but all in.
What happened to all that excitement about German stimulus over in Europe? And we're looking at one handles on GDP. For growth for the continent.
Yeah, this is the whole thing. What would it look like without that? And this is the reason why people aren't that worried about absorbing the debt, given how little there has been sold so far and how much there is to do.
I imagine the ECB president, in about 20 minutes' time when that news conference starts in Frankfurt, Germany, is going to stress the risks around that outlook from the ECB. If you're not pre-committing to a path, I don't think you're celebrating either. And given the risks surrounding the trade story, particularly what it could mean for the continent too, I don't think the disinflationary risk from Chinese overcapacity has gone away. And that could be something they have to confront in the years to come.
What I want to see is the emphasis. Is it on the disinflationary impact coming from China or the inflationary impact coming from tariffs? And that will determine where the risks are. Is it to a potential hike or is it to a potential cut? Should there be disinflation and growth that is at this pace?
Look what we're hearing from Mexico as we wake up this morning. Mexico looking to put the walls up to Chinese imports, to please the United States and ultimately come to a deal with them next year.
Especially when it comes to things like autos. China absolutely flooding Mexico the way it has been flooding Europe, to your point. It has been surpassing some of these companies like Tesla when it comes to growth in Europe because they are just so cheap.
We'll get to the inflation story in just a moment. CPI just around the corner. Tiffany Wilding of Pimco joins us. David Kelly of JPMorgan Asset Management. The inflation data just minutes away. Inflation data just around the corner. Equity futures, your scores going into it look like this. Positive by 0.2% on the S&P, up by 0.3% on the Nasdaq 100. On the Russell, up by 0.3%. Also, the small caps, very sensitive to what happens here at the front end of the curve. 2s, 10s and 30s look like this. Your 2-year bond yield so far this morning at 355.19. Yields higher by about a basis point. With your inflation data, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, we've got a hotter than expected reading as CPI on a month-over-month basis rises 0.4%, 0.3 as expected for the core. The year-over-year rate goes to 2.9% from 2.7%, and the core rate goes to 3.1%, stays at 3.1%, we should say. The other number out just now, initial jobless claims, big jump there, 263,000 last week. Don't have the previous revised number, but the unrevised number was 237. So a significant movement there. In terms of continuing claims, 1,939,000. That's a drop from 1,940,000. But remember, those are a week behind, so they're still reflecting lower rates of unemployment insurance filings for the month for the previous week. In terms of what we got here, index for energy was up 0.7%. There have been concerns about the fact that AI power plants are raising prices to try to pay for all the power that the AI people need. Food increased 0.5%. That's going to be a political problem for the president. Food at home up 0.6%. Airline fares, used cars, trucks, apparel, new vehicles all rose. I'll get you those figures in just a moment. But the index overall for services is something that we are concerned about. And services, less energy, the core services rate was up 0.3%. That's a little bit of a decline from 0.4 last month, which scared overall economists. But still, this number is nothing to write home about for the Fed. Probably not enough to dissuade them from, or to persuade them to do 50 basis points or dissuade them from 25. But it is still a higher number than forecast.
Mike McKee, I'll get to the markets. We'll come back to you in just a moment. Stay close. So we've got a bit of tension here. Small upside surprise on headline CPI, but a big upside surprise. The wrong kind of upside surprise on jobless claims. What wins out, you decide. I don't have a view, but the chairman does. The chairman of the Federal Reserve has told you that the labour market is the thing that he's focused on right now. So push that view through the bond market at the moment, and we're trading on claims. Yields are down at the front end of the curve by 6 basis points, 348. The dollar's weaker, euro dollar back through 117. Equities positive, Bramo, by 0.25%.
Yeah, if you take a look at the 4-week moving average of initial jobless claims, they came in at the highest pace going back to June, but the fastest pace of increase in that metric going back to December of 2020. To the extent that we saw downward revisions, the labor market very much front and center for the market. What I would suggest is this is a market that is gaming out a longer-term weakness in the labor market that suppresses yields across the curve. This isn't just the front end. I think that is telling you something.
Mike McKee, you've got a second look. What do you see?
Well, right now we're looking at new car prices up by 6%, according to this. No, that's used car prices. I'm sorry. New car prices up by 0.7%. So big rise in new car prices, but an even bigger rise in used car prices. That's been in the wholesale data for a while. Apparel prices were flat after falling 0.3% last month. So maybe a little bit of the tariff impact is hitting there. Remember, yesterday, retail and wholesale margins compressed, suggesting that some of that is being absorbed by middle people. Gasoline prices were down 6.6% now on a year-over-year basis, down 0.7%. In terms of down 1.7%, I'm sorry, in terms of the month-over-month numbers, and that didn't keep us from getting a much higher rate of inflation for the headline.
Mike McKee, appreciate the update. Michael, thank you. Joining us now is Tiffany Wilding of Pimco. Tiffany, welcome to the programme. Is there a stagflationary-like mix coming together here on the data that you see?
Yeah, so I think we're getting what we expected on inflation. We're getting some pass-through of tariffs. It looks like it's predominantly the firming categories are in goods, and otherwise, things look a little bit better. I think the more concerning news from the data this morning is the jump in claims. It's been relatively contained despite the labor market, really slowing to a halt over the last year. And now the jump today looks a little bit more concerning, like we're moving out of just a period of very little activity or very little hiring or firing, to potentially some more separations. And that's going to be super concerning, I think, for the Federal Reserve. I agree with Mike McKee. I think overall the data this morning, confirms a 25 basis point cut. There's probably going to be discussion around 50, although that's not our base case. And I think there's reasons if you continue to see this kind of momentum on the labor market, to get several more cuts in the back half of the year.
Tiffany, what I find interesting about the market reaction is that, yes, they're picking up on this idea that claims came in at the wrong kind of upside surprise, as John was saying, and that the trailing average is picking up at a remarkable and alarming speed. But that longer term, we're seeing the 10-year yield now break below 4% for the first time this year. I mean, we're looking at a 10-year that is also responding. Are you changing your longer term trajectory for U.S. growth prospects on the heels some of these labor market revisions and the sort of negativity that we're seeing from the claims?
Well, I think that, just the fact that the U.S. Treasury market continues to be a hedge for macroeconomic risks, for riskier asset volatility, I think is why you're seeing movements, in the longer end of the interest rate curve. I think when we look at, sort of valuations, we think kind of intermediate sector looks attractive here, does still provide risk, against downside protection, and it's something that, that we've been very focused on. So it's not surprising necessarily to me that you're seeing it in longer dated interest rates. I think overall on the economy side, we are really entering this kind of period of weakness, potential weakness. We'll see some fiscal supports that are offsetting the tariff effects, but they don't kick in until, the beginning of 2026, call it February, March, when consumers are starting to get really big refunds from retroactive tax cuts. But until then, we're really kind of in this period of weakness. And to us, the question is, some of these smaller and mid-sized businesses that are really having to shoulder the effects of tariffs, maybe they're not getting as much benefit from the one big beautiful bill tax cuts, can they really hold on here without firing people? And it seems like, maybe there's more concern around that, as we're watching the data.
Tiffany Wilding of Pimco. Tiffany, great to catch up with you. I know you've got to catch up with clients too, so thanks for making time for us this morning. Let's move in the bond market. This data is good for bonds. It's questionable for equities. Equity futures just about unchanged. We'll see if this move sticks, but at the front end of the curve, we're down 6 basis points. And as Lisa pointed out, we're down across the curve. And this is largely because of the way the Federal Reserve Chair set things up. Coming into September, he basically told us the following, that you could have a one-off effect on inflation, but not all at once. And the labour market data was concerning him, which is why we're seeing yields down this morning, because there's much more emphasis on what we're seeing on claims.
And it seems like the idea that you're seeing a pickup in layoffs, to Tiffany's point, raises the question of how companies are adapting to some of the higher input costs. I was looking at some of the specifics here in the CPI print. Airline fares up 5.9% on the monthly basis. So again, it talks about the K-shaped economy and how the Fed is trying to cater to people who cannot afford to pay that. Those who can are.
David Kelly of JPMorgan Asset Management standing by. David, you've been looking at the data. Just want your first reaction, please.
I think both with regard to the CPI and with regard to the claims, everyone should sort of take a deep breath and not overreact to them. On claims, key thing to think about is last week was a week that contained a Monday bank holiday, or a bank holiday you call it in the UK, but a Monday holiday, Labor Day. The unemployment claims data are notoriously bad in a week that contains a public holiday. They just have never figured out how to seasonally adjust that properly. So I think that's an overshoot on claims, and I would not be surprised to see that number come down next week. Now, it still fits into a mosaic of a slowing labor market, and I don't deny that. I think the economy is gradually grinding to a halt here, but I think that overstates the deterioration in the labor market. And then similarly on inflation, these numbers are very close to in line with what we thought. The big surprises were probably an increase in motor vehicle repair costs, 2.4% month over month. And then, as Lisa was just saying, a 5.9% increase in airline fares. But remember, they fell very sharply over the course of the summer as airline travel was down. Now it's picking up again in this K-shaped economy. So overall, the economy is still moving forward slowly. Inflation's gradually going up. The economy is gradually slowing down. That's what we thought tariffs are going to do. It's going to slow growth and it's going to add to inflation. But I don't think it's nearly as dramatic as either of these numbers suggest this morning.
Well, David, let's just stay on the labour market story, because that seems to be what the market is moving on, at least initially. You think the claims data maybe overstates the weakness. Do you think the step down in payrolls growth overstates the weakness too?
No, I mean, we saw the big down revision yesterday or earlier this week. That was not a surprise. No, I mean, there's weakness. The thing is, as Jay Powell has pointed out, it's a very curious kind of labor market because we're having a huge reduction in labor supply at the same time. So this does not speak of significant, labor market weakness. I mean, it's still a tight market. It's still hard to find good people. But I do think it reflects the fact that businesses don't want to hire here. I don't think there's a huge ongoing jump in layoffs, but it's getting harder and harder to find a job because businesses are just frozen because they don't know what the playing field is going to be with regard to tariffs going forward. And I think that is, that's the biggest thing that I think people are ignoring here.
David, a lot of people are hoping that things pick up in 2026, that the growth story gets better, fueled by the rate cuts we're about to see. Speaking of things maybe that we underappreciate, something you've been talking about for a while, this tax bill, the kind of stimulatory effect it might have in 26. Could you just sort of outline that for us this morning?
Absolutely, really important. All these new tax cuts, getting rid of the tax on tips over time, increase the standard deduction and so forth, the SOL tax break, all of them were made retroactive to January 1, 2025. But the IRS has not changed withholding schedules. That means that there's going to be basically a full year's worth of refunds on all of those tax breaks kick in the first few weeks of 2026 or first few months of 2026. That is the equivalent of big stimulus checks. Last year, the average income tax refund was about $3,200. This next year, in 2026, we think it's going to be over $4,000, with 70% of households receiving that. That is like one big stimulus check, one big lump of sugar put into the economy early next year. So if we can get to the first quarter without slipping into recession, there is, there'll be some stimulus there. But I do think that between now and then, the economy is going to be slowing in the fourth quarter.
David, appreciate it. David Kelly there of JPMorgan Asset Management. The data coming in a bit hotter than expected on CPI, but the claims numbers not pretty. Now, David thinks maybe that overstates the weakness in this labour market, but at the moment this bond market's trading on it. Yields are lower across the curve. 2s out to 30s. We're down about 6 basis points on 2s. We're down 4 on 10s. The questionable story, what does that data mean for the equity market? Equity futures positive by about 0.1%. Up next, an ECB president, Christine Lagarde, taking over the news conference in Frankfurt, Germany. From New York City, you're watching Bloomberg TV. Live from New York City, welcome back to the programme. We want to pause now for a moment of silence being held throughout the city of New York in remembrance of the September 11th terror attacks. At this time, 24 years ago, hijacked American Airlines Flight 11 struck the North Tower of the World Trade Center.
Right, quick, march.
We'll bring you the next moment of silence at 9:03 Eastern Time. In the meantime, I want to take you to Frankfurt, Germany, where ECB President Christine Lagarde is giving a news conference.